Time value of money or mathematics or finance. Okay. Why do we want to study this? Okay. At your inter or final, even in your practical life, always you invest and expect some return, right? The return what you expect in the future should be higher than the amount what we invest today. If I invest today, I will get 105 1 year later. So definitely it's a profitable one. So because I'm getting 5 rupees excess. So today's investment, tomorrow's return. The difference between these two is my income. Provided the income seems to be attractive and profitable, provided if I invest this 100 rupees in the bank, how much will I get? Bank gives you 8% interest. For the 100 with the 8% interest, 1 year end it becomes 108. Okay. In a business, if you invest 100, it becomes 105 in a matter of 1 year. So you gain 5 rupees in a matter of a year's period. But the same, if you are investing in a bank which gives you 8%, you can safely get 108 without any risk and you need to work. So from this, it is very clear, while comparing today's investment and tomorrow's investment, always consider the interest component. If I invest today, together with the interest, it becomes 108. My return from this riskier business should be more than 108, only then I can exit. Okay, I cannot simply see 105 rupees I'm getting, so it's profitable. No, definitely not so, because without work, if you are investing in the bank, you'll get decent amount of 8 rupees. So 100 becomes 108. Rather than investing in some way, okay, gives you 105, logically not accepted. But if it gives 115, okay, you will be very happy because you are getting more than the amount you are getting from the bank. So always when you are going to compare what about your benefit you are getting because of investment, the benefit should be higher than the returns you expect from the banker, which is the interest. 100 plus 8, 108 from the banker. If I invest the same 100 in a risky business, it should be more than 108 because there's a risk. For the risk also, I demand something extra. So in our study financial management, always we think over investing today, expecting return future. In absolute sense, comparing these two is meaningless. Today I invested 100, tomorrow I get 105, so I get 5 rupees profit. Comparison of that is meaningless. Is that okay? So today I invest 100, tomorrow what I get should be more than the interest benefit. Only then I will expect this project being good enough. Not only that, another component is also there. Okay, two components are there. Today's 100, in 2025, we have 100 rupees in a bank, in our purse. 2026, you have 100 rupees in your purse. That remains same, but not necessarily same if it is invested in the bank. These two are not same. If you are investing that 100 rupees in the bank, 1 year later, together with the basic interest, say 5%, it becomes 105. It means today's 100 rupees should be equal to 105. Is that clear? Hope you will be able to now understand. So how can I compare, sir? Because we are investing in different periods. I invest today, but get the benefit later on. Comparing these two is meaningless, right? 100 rupees, 105. Comparing these two is meaningless. But it can be brought to today's worth. It can be brought to today's worth. Okay, that's the thing we are going to study. Time has some value in money. That's what about time value of money. Okay, time has some value in money. Clear? Time value of. If the inflation rate is higher than the interest, it's better to purchase today itself. You can borrow and pay the interest. Okay, today you borrow and pay. You borrow and pay 5 lakhs rupees. This borrowing becomes 10 lakhs sometimes later, but by the time the car becomes 25 lakhs, you are pretty happy. You understand? Simple logic, I'm telling you. And the preliminary study, interest and inflation. Inflation. We never bother about the inflation at foundation as well as inter level. We'll consider only the interest component. Inflation you will study or incorporate at your final, not now. Okay. So today's 100 is not equal to tomorrow's 100 because of two reasons: interest rate as well as inflation rate. We never bother about the inflation rate calculations at foundation or inter level. But we need to understand the interest rate calculations in detail. Today's 100 is not tomorrow's 100, because if you invest this today's 100 in bank, together with whatever the bank interest, probably around 10%, which gives you 10 rupees interest. So 100 plus 10, it becomes 110. It means today's 100 is equal to tomorrow's 110 in bank's point of view. Right. So predominantly, we assume this way: 0, 1. If I invest 100 today, if the rate of interest applicable for this being 10%, for that 100, you have to calculate interest which is 10 rupees at the rate of 10%. Usually, you can represent the rate of interest in decimal 0.1. Okay, that may be bit easy calculation. Like, if you add up these two, then you will get 110 by the end of first year. Today's 100 rupees is called the principal. Tomorrow's 100 rupees is called sum of money. And the 10 rupees you added with today's investment, is called interest amount. I use a capital I for the amount of interest, small I for the rate of interest, P is the principal value or present value. Present value. And this is sum, or it may be named as future value. Either you can name this being sum or future value. Today's 100 is equal to tomorrow's 110. Today's 100 being present value, tomorrow's 110 being future value. If I ask you, what about the future value of future value of rupees 100? Future value of rupees 100. Okay. Is equal to 110. What is the present value of rupees 110? 100. You understand now? So this value will be called as the present value. This will be called as the future value, or you can use the term sum, or simply you can use the term F also. Okay. Small I represents rate of interest, and you usually use the decimal mode of calculation, so that it may be pretty simple. Now, how many years you have to wait for this? 1 year. Then this is called number of years. You invest today 100, 3 years later, how much will I have? If I ask you what's the future value I have after 3 years with the rate of interest 10%, then in this case, n is equal to 3. So this number of years that you wait for getting your money back will be called number of years, or simply use this small n. Hope now you'll be able to understand the notations. P, present value or principal amount, and F represents future value of some money. I represents small I represents rate of interest, and capital I represents amount of interest. N represents number of years of periods. Number of years are periods. Now, what types of practical problems you need to be thorough before you proceed further? Calculations. Okay. Present value or discounting. Present value or discounting, or future value. Okay. Clear? Present value and discounting. You know that present value is not equal to future value. Okay. To bring the future value to the present value, you have to discount this. The term used is called discounting. The term discounting represents removing the interest in the future value. 100 is today's value, 110 is tomorrow's value. The 110 tomorrow's value includes the interest for the 1 year rupees 10. To bring that 110 today's value, you have to remove that 10 rupees, discount the 10 rupees to bring it to 0th period. Similarly, if you want to bring the future value, you have to find using the compounding or future value. Okay. Bringing the future value to the today's value is called discounting. Taking the today's value to the future value, compounding. Whatever the comparisons may be, inflow, outflow, cash. I put 1,000 rupees, I'm getting 1,500 rupees. Can I compare the 1,000 and 1,500? Absolute sense, no. 1,000 invested at the 0th period, the 1,500 I'm getting around 10 or 15 years later. 10 or 15 years later, 1,500 is not a meaningful. I invest today 1,000, 1 year later I get 1,500. 50% growth in a matter of 1 year. Very exorbitant growth. No such growth available anywhere in the financial market. Right. If I invest 100, I'll get 101 by the end of first year. I'm getting only 1 rupee extra. So I'm getting only 1 rupee extra. Very, very small growth. Instead of that, I could have invested in the bank. Do you understand now? Similarly, present value as well as future value. This will be 100, this will be 120. You cannot compare these two. You have to convert this into the present value by discounting. What about the discounting value? It may be 101, sir. Then we can compare these two. Comparison of these two is not acceptable. Okay, 120 2 years later will be equal to today's 101 using the discounting factor. Using the discounting factor. Is that clear? That's the logic. So you may be asked to calculate the future value, amount of interest, present value, rate of interest, and number of years. These are the questions you may be asked in your exams. Now, see here. Simple interest calculation. Simple interest calculation. Okay. What happens? This is how you can use a timeline. 0th period, first year, second year, nth period. If you invest at 0th period some amount, that is called principal. Together with the applicable rate of interest, it becomes some value in the future. Some value in the future. Right. Now, the difference between S and P is nothing but amount of interest. For the calculation of some value or for the calculation of interest, how can I calculate the amount of interest, sir? Principal value, number of years multiplied with the rate of interest. This is how you can calculate the amount of interest. How can I calculate the sum, sir? Sum is nothing but principal value plus interest. Is that okay? 1000 rupees invested, rate of interest applicable being 0.1 and number of years being 3. Now what is the sum? Sum or future value. Very simple. For 1000 rupees at the rate of 0.1 for 3 years, it will be 300 rupees. This is interest. For sum is equal to principal amount plus interest. Principal amount being 1000 rupees and the amount of interest being 300. Together with that, the total value being 1300. 1300. Clear? 1300. You can rewrite this way also. Principal plus PNI. The I is nothing but PNI, no? So you can add the PNI with the P also. Is that okay? Even you can simplify. P can be taken out. P can be taken out. So if I take the P out, the formula will be 1 plus NI. Different angles. Try to understand the formula and mug up and use it in a different angle wherever it's required. So amount of interest being PNI. Sum or future value is equal to P plus PNI. Clear? Now let's start with the first illustration. Come on, join with me to solve this illustration. Okay. Actually, in the old text, I have given all these calculations put together in a single page. In the revised book, no, for simple interest and compound interest, all these calculations are independently given. That's the only difference. Okay. A summary like it is given in the first page itself for the old book. Okay. Revised book has different pattern. But the sum will be the same. Sum will be the same. Come on. Try to solve this illustration. Join with me to solve this illustration. Online students, I request you to solve and post the answers as soon as possible once you complete it. Future value, amount of interest, you have to calculate under simple interest. SSA loaned 1000 to a friend for 3 years at a simple interest rate of 10%. 0, year 1, year 2, year 3. The loan amount being 1000, applicable rate of interest in this case being 10%. What total amount did SSA receive back from their friend at the end of the 3 years. So it means how much he will get by the end of the third year. F should be calculated. F should be calculated. So what is the requirement? You have to calculate what is the F, as well as you have to calculate what is I. Under simple interest method, the capital I, amount of interest, is equal to principal amount into number of years applicable into rate of interest. Principal amount in this case being 1000, number of years applicable in this case is 3, rate of interest here being 0.1, otherwise 10 by 100. It's preferable to use the decimal. Anyhow, you are not going to calculate, you are going to use the calculator. So you always use the decimal. And the interest amount in this case being 300, then F. F is equal to principal plus interest. That principal in this case being 1000, amount of interest being 300. So future value being 1300. Hope now you'll be able to get this answer. So I got the answer from Srimati already. What about the others? Keep texting. Do you have the same sum in CA Foundation? CMA Foundation don't have the same sum. Okay, then I have improved. Okay, no issues. You can copy the sum and you proceed with. But it may be available in your text with a different name, I think. You don't have simple interest calculation. Yeah. Okay, no issues. 14 sum. Now I improved this with the 26 illustration. Oh my God. Okay, then I'll share that. I'll share that additional material only, right? Present value under simple interest. SSA loaned a friend some money at 10% annual simple interest rate. After 3 years, so year 1, year 2, year 3, 0, 1, 2, 3. Okay. So I am not aware about the sum money, but rate of interest applicable being 0.1 and period being 3 years. SSA received a total of 1300 later on. This 1300 is nothing but what? Future value. What is the original amount of money? So now we have to calculate what is the sum. What is the sum? So you know that future value is equal to present value plus present value into NI. So I know future value N and I, but I don't know P. What you can do? Take the P out, 1 plus Ni, or you can substitute there directly. F in this case being 1300, I have to calculate the P, 1 plus N being 3, and rate of interest being 0.1. Then 1300 is equal to P. This is 0.3 plus 1, 1.3, 1.3 P. This is nothing but 1.3 P. Then for calculation of P, 1300 divided by 1.3, the P being 1000. Then what about the interest? Though they have not asked the interest, but we can calculate interest also. We can calculate the interest also. So interest is nothing but the difference between future value and present value. Future value being 1300, present value being 1000. So the answer being 300. Okay. Hope I have seen 2 answers in online. Udayshri has given me correct answer. Mahisha has to improve, right? Hope you might have calculated rate of amount of interest based on this value. No, it's a reverse calculation. Hope now you'll be able to understand. Shall I move on to the next illustration? Clear? I didn't get any message from Mahisha. Clear now? What about the others? Online students need to text me very often. Yeah. Third question. In this illustration, we are supposed to calculate rate of interest under simple interest. SSA lent 1000 to a friend for 3 years. After 3 years, SSA received a total of 1300. Timeline. 0, 1, 2, 3. Investment made at 0th period 1000, and the lending becomes 1300 by the end of third year. We are not sure with the rate of interest here. Assume simple interest method. So now you have to find out. Sorry, rate of interest is missing, right? You have to find out the rate of interest. Now you can find out the interest. The formula for interest is future value minus present value. Future value being 1300, present value being 1000. 300. You know that interest can be calculated the other way, PNI. Amount of interest being 300, P being 1000, N being 3 years, but I am not aware about the rate of interest. So in this case, rate of interest is equal to 300. I transfer this value to the other side, denominator 3000. So the value being 0.1, otherwise 10%. Hope now you'll be able to understand this. So I got the message from Akshaya, Naranjana, Reshma. What about the rest? Make it faster. Now, question number 4. In question number 4, we have to calculate the number of years under simple interest. SSA loaned 1000 to a friend at a rate of 10% simple interest, and SSA received a total of 1300 after a certain period. What was the duration? Duration is the N. We have to calculate that one. 0, 1, 2. I am not aware about the duration, so it should be calculated. Here. Principal value being 1000 and future value being 1300. Applicable rate of interest in this case being 0.10. Now we have to calculate what is the number of years. Now you can use any one of the formula. Interest is equal to the difference between future value as well as present value. Future value being 1300, present value being 1000, so amount of interest being 300. The other way you can calculate the interest this way, PNI, I being 300, P being 1000. I am not aware about the N, and small I, rate of interest being 0.1. Otherwise, 100 N is equal to, if I multiply 1000 into 0.1, 100 N, 100 N is equal to 300, and my N is in this case 300 by 100, 3. So 3 years. Same illustration, but I calculated different requirement here. In first case, we calculated the S, in the other case, we calculated the P. Once we calculated the amount of interest, once we calculated the rate of interest, and once we calculated the number of years. So logically, you have to understand the concepts, the calculations part. Calculation of future value, calculation of amount of interest, capital I, calculation of present value, sum value or P, rate of interest calculation, small I, and number of years. So we have calculated all these things. Growth rate or CAGR we will study separately. Once it comes, that will understand. Under simple interest, what we have done is the same. Now we will move on to the compound interest cases. Compound interest cases. We have calculated all these things for simple interest case. The same happens for the compound interest case also. When it's all about compound interest case, we have two patterns: single cash flows case and annuity case. So now we have completed simple interest case where we calculated all the 5 elements as per the requirement. Clear? We will now move on to the compound interest. As per the compound interest calculation, for every year you calculate the interest, that interest is added with the original value. Next year you will calculate the interest on the total. Original value plus accumulated interest thereon. For example, at the 0th period, you invested 1000 rupees. By the end of first year, you have to, the applicable rate of interest being 10%. You have to calculate interest on this. Interest is always principal value into amount of rate of interest. So it is 100. This will be the future value by the end of first year. 1100. Second year, you usually calculate on the same value, principal value, which is again 100, 1200. That's how you can calculate under simple interest model. We have completed the simple interest model. This is nothing but future value by the end of second year. For the third year, again you calculate the interest for the second means original value. For 1000 at the rate of 10% is 100, and you will get the future value in this case being 1300. So every time you calculate the interest only on the original value. That's similar to the straight line method of depreciation like. Straight line method of depreciation like. Under compound amount, what happens? Compound interest. 1000 rupees, for that interest being 100, 1100. In the next year, if you want to calculate interest, for this value, you have to calculate interest. For 1100, at the rate of 10%, the interest for the second period is 110. So the value being 1210. And third year, for this 1210, usually what you do in case of written down value of depreciation, whatever the original value, from there depreciation is subtracted. The written down value is the base for calculating the amount of depreciation for the next year. In the case of compound interest, whatever the original value, with that interest is added, and on that only we are going to calculate interest for the next year. This is called compound interest. The small difference between compound interest and rate of depreciation is means written down value of depreciation means here addition, there subtraction. Okay, that's all. The formula also same. The formula also same. Slight differences there. So I'll explain all these things in this class itself. Right. So here for this 1210, 10% being 121. 121. Is that okay? And ultimately you get 1331. The main point to be noted here is under simple interest as well as compound interest, the amount of interest will be same in the very first year. Same in the very first year. In the second year, the difference between these two, 10 rupees, is nothing but interest on the first year's interest. This is simple logic you have to keep at least for the 2 years. First year, under simple or compound interest, whatever method you follow, the amount of interest will be the same. Under SLM or WDV method, whatever it may be, first year depreciation is the same. No, the same happens here also. The first year amount of depreciation will be same. In the second year, the difference in the amount of interest only due to the interest on interest. That interest on the first year is 100. For that, if I use the rate of interest being 10%, that will be 10. That 10 will be the difference. And subsequently, again, the sum becomes very complicated. Because interest on interest, all these things are already accumulated. Now, how can we calculate, sir, in this case? For example, okay, 0, period 1, period 2, period n. P value and S value and rate of interest. Or rather than this may be named as S, we can name this as our familiar term F. So I. How can I calculate the F, sir? In this case, F is equal to P into 1 plus I to the power n. Clear? F is equal to P into 1 plus I to the power n. Clear? How can I calculate the P, sir? P should be F into F divided by 1 plus I to the power N. Okay. 1 plus I to the power N. Is that clear? Or you can write this way also. F into 1 plus I to the power minus N. Okay. So, in simple interest, we memorize the formula. Similarly, here also you can memorize this formula. I will guide you how to calculate all these things after this also. Okay. How this formula is derived. We'll discuss that later on as an addendum, not now. Here you just understand the formula and mug up how and when can be used. That's more than enough. So, for the calculation of future value, you have to multiply the 1 plus I to the power n with the P, you will get the future value. To get the present value, okay, F is divided by 1 plus I to the power n. That's all. So, these are the two predominant formula you can keep in your mind. Same formula represented two different mode. Right. Now, future value or compound amount. Usage to calculate the future value of the single deposit. We have completed this one. And present value or discounted amount, usage is nothing but to calculate the present value of the future sum. The formula being P is equal to F by 1 plus I to the power n or F into 1 plus I to the power minus n. That's how you can understand. Sir, what about this one, sir? I will get back to be discussed later on, not now. I will explain later on. Clear? Now, hope so you could now understand this part as well as this part. Clear? So, you have to master with these two formula. For future value, this is the formula. And the usage of this formula being to calculate today's deposited value, how much it could be in the future, we can apply this formula. Future value, future value or compound amount value. You can either name this being the future value or compound amount. And this is the second part. This is the only inverse of the earlier one, where future value is given, you have to calculate the present value. Okay, present value, otherwise it may be named as discounted amount. Okay, when I ask about future value or compound amount, both are interchangeable. Don't get confused with the terms. Present value or discounted amount also be interchangeably can be used. Also can be interchangeably used. Is that clear? Hope now you'll be able to understand. Now, let's move on to the first illustration here. SSA future value and amount of interest under compound interest pattern. SSA invested 1,000 in a fixed deposit for 3 years at a compound interest rate of 10%. Invested 1,000 in a year for 3 years for foundations. For 3 years at a compound interest rate of 10%. What total amount did SSA receive back at the end of the 3 years? Okay. Also find out the amount of interest. Under future value calculation, F is equal to P into 1 plus I to the power n is the formula. In this case, P being 1,000, 1 plus I being 0.1, n being 3 to the power. Now, come on, get me the value. Srimati has given me the answer. Okay. In your non-scientific calculator, this one will be first calculated. 1 plus 0.1 is nothing but 1.1. To the power 3, no. You just press into and press equal. You will get the power 2. Again, press equal, you will get the power 3. Okay. If you want to calculate power 5, do that same. Press the equal 4 times. One shot, you will get the answer. Cross verify. Of course, we don't have the power calculator. We don't use the scientific calculator as we are using only non-scientific calculator. To get this, you can use this simple shortcut. Okay. So 1.1, 1 plus I to the power 3 means into equal is equal to the power 2. Again, if I press again, then it will be getting power 3. So 1000 into 1.331. Cross verify all whether you are able to get this. Now the final value being 1331. So if I lend 1000 rupees together with the compound interest, how much will I get by the end of third year means it's 1331. And if I want to find out the income only, that interest component only, which is nothing but the difference between today's value and tomorrow's value. Tomorrow's value is the future value. Today's value is usually named as P. Tomorrow's value being 1331 together with the interest you are getting by the end of third year. Today you have invested only 1000 rupees. If you subtract that 1000 rupees from 1331, your amount of interest being 331. Amount of interest being 331. Good. So Niranjana and Srimati gave the answers. Okay, others also I request you to participate here answering me. Right. Now, SSI invested a bond, some money at a 10% annual compound interest rate. After 3 years, SSI received a total of 1331. What was the cost of the bond? So, 3 years. SSI invested some money. He doesn't know what is the sum money or principal amount. Applicable rate of interest being 0.1. In future, he gets 1331. Now the question is you have to find out the S. You know that for the calculation of future value, this S can be otherwise named as P. P into 1 plus I to the power n. To calculate the P, you take this to the other side. F divided by 1 plus I to the power n. You can use this formula or you can use this formula. F into 1 plus I to the power minus n. You can use one of the formulae. Both are same. Both are same only. Future value being 1331 divided by 1 plus 0.1. Isn't it? Rate of interest 10% is nothing but 0.1 to the power 3. Now 1331 divided by, I need to find out the denominator value. Use the non-scientific calculator the same way. 1 plus 0.1 is nothing but 1.1 to the power 3. To the power 3, just to press into, press equal, power 2, power 3. You get this value, 1.331. 1.331 is the answer. Okay, 1.331 will be the answer. Then ultimate value being 1000 rupees. Can I use the other formula, sir? 1331 into 1.1 plus 0.1 to the power minus 3. 1331 into. How can I find out this answer, sir? This answer is nothing but 1 divided by 1 point or 1 plus I to the power n, you know, it's a inverse. Okay, this value being 1.331, otherwise this one. Okay, you can use this one. 1 divided by 1.331, you will get the answer directly. This value being 0.751. 751315. 0.751315. Now, if I multiply with 1331, I will get the final answer 1000. Remember, how can I calculate this directly, sir? This value. 1 plus I to the power or 1.1 to the power minus 3. How can I calculate? This is nothing but 1 divided by 1.1 to the power 3 only. No. In your non-scientific calculator, you can do this way. 1 divided by 1.1. Just to press 1, this is what about the power minus 1. Again, if I press the same, you will get power 2. Again, if I press power 3, I will get the answer easily in your non-scientific calculus. For the present value, 1 divided by that same value equal. So first equal is equal to power minus 1. Second equal is equal to power minus 2. That's how we can get the answer. Hope now you'll be able to understand the applications of calculator also here. So that's why I tell you, use non-scientific calculator, especially for calculator for CA foundations and CA. Get that calculator and practice with that. The usage should be mastered. You have to master with the usage also, right? Yeah. Finish off copying the sixth one. We'll then move on to the next one. Shall I move on to the next one? Now, rate of interest calculation. SSA purchased a bond for ₹1,000, matured in 3 years. After 3 years, SSA received a total of 1,331. What was the interest rate for the loan? 0, 1, 2, 3. P value being 1000, F value being 1,331. You have to calculate I. So we have been given P, F, N. These are the three main elements. Now the question mark is this one. So you have to calculate this one. Clear? Right. In case F is equal to P into 1 plus I to the power N, right? You can use the trial and error method to get the answer. Trial and error method. F is equal to 1,331. P is equal to 1,000. 1 plus, I am not sure with I, to the power N is 3. Otherwise, 1 plus I to the power 3 is equal to 1,331 divided by 1,000 is equal to 1.331. So 1 plus I to the power 3 is equal to 1.331. So you can use the trial and error method. Trial and error method. I'll just give a shortcut for the trial and error method. See, the difference between these two is 331 for 3 years. Then roughly per year it may be 110 rupees. Your today's investment being 1,000. So the answer could be roughly 11% closer. It may be 11% closer. Okay, that's how you can guess it. 1,000 rupees you invested over the 3 years period, it becomes 1,331. It means you are getting 331 additionally. So 331 for 3 years means per year it's roughly 110. Rough only. For the today's 1,000 rupees, you are getting 110 means roughly you are getting 11%. So required answer should be 11% or less than that. You can apply the different rates here. See here, if the rate of interest in this case being 11%, will I be getting the answer correctly or not? Let's see. 1.11 to the power 3 is equal to 1.331. Do I get this value or not? Come on. 1.11 to the power 3. What's the value?
3.
So 1.11 to the power 3 equal. So 1.3676. 1.3676 is equal to 1.33. Is it true? No. So the answer is not correct. So as per my requirement, this will be correct one. 1 plus I to the power 3 should be equal to 1.331. 1 plus I to the power 3 should be equal to 1.331. But I'm not aware about the I. I just guess some value, probably 8%, 7%, 10%, like I guess. How can I guess? I have given a shortcut here, rough guess 11%. If I use 11%, the answer is not correct. So definitely 11% is not the answer. Now what you have to do? This is the value you need to arrive. This is the value you arrived. You have to reduce the value, no? You have to reduce the value, no? To reduce the value, what you have to do? You reduce the rate of interest. For the calculation of future value, you have to reduce the value. For calculation of the present value, you have to increase the value. So here we are going to calculate the future value related. So we have to reduce. From 11, we can reduce this to 9% like. If I use the 9%, the answer being 1.09 to the power 3 is equal to 1.331. I am substituting the I with the assumed numbers. Then this value being C here, 1.09 power 2 power 3, 1.2950. 1.2950 is equivalent to 1.331. No, it is not correct. No, it is not correct. So 11 seems to be higher value, 9 seems to be lower value. Then the required answer should be anywhere between these two. We'll start with the 10. Okay. Or you can use the interpolation. I will explain that interpolation concept later on in detail. So now I'll assume that I being 10%. If I being 10%, 1.1 to the power 3 is equal to 1.331, and 1.1 to the power 3 is equal to, so 1.1 to the power 3, power 2, power 3, 1.331. So now these two are matching. My required answer is arrived. From this it is very clear. The requisite I in this case being 10%. This is one of the easiest method where we don't have the scientific calculator. We use the trial and error method. Sir, it is being 10%, you got it correctly. If it is being 10.5 or 9.5, how can we calculate? So in that case, we can use the interpolation. I will explain that later on. There are n number of methods are available. Even you can use the log, and you can use the scientific calculator. Whether whether the scientific calculator is there or not, you can use a shortcut for these calculations. Shortcuts are already given in Singer Academy's video, but of course not required for the examination. I currently so skip that one. Memory means probably shortcuts for in free lectures. You have been given the shortcuts. Okay. Calculator tricks. You can go and watch that calculator tricks to calculate the answer directly. But of course, you no need to play with the all calculator tricks for your examination. That's only tricks. No, why do you use the tricks for your exams? So, but for additional learning, you can go and watch that one. Calculator tricks given in the free videos here. Right. Now listen. Now listen. Hope now you'll be able to understand this. This method is called trial and error method without interpolation. I will guide you what is called interpolation to calculate exactly. Okay, calculate exactly. So stream method, the interest rate is not 1.1, it's 0.1. Okay, 0.1. 1.1 is after adding rate of interest. So the interest rate in this case is only 0.1 or 10%. Clear? Now, these are the different rates I guessed. Now, see here. Have you copied this? Copied or not? Yeah. Online students, come and text me so that I will move on to the next one. C, future value is equal to present value into 1 plus I to the power n. I want to calculate I, then 1 plus I to the power n is equal to future value divided by p. 1 plus I, the power n is transferred to the other side. This becomes what? Nth root, future value by p. I want only I, so the 1 will be transferred to the other side. Nth root of f by p minus 1. This is the formula for calculation of I directly. Okay. In this illustration, okay, this is the data. So what happens? I apply this formula here. I is equal to nth root. What is the n here? 3. What is the future value? 1331 divided by, what is the p? 1000 minus 1. Minus 1. Then I is equal to third root of 1333 divided by 1000 being 1.331 and minus 1. Root you can calculate, fourth root also you can calculate using the non-scientific calculator. But in case of third root, fifth root and all, calculation using the non-scientific calculator is really tough, not required. Yeah, of course, you can use the scientific calculator, some shortcut tricks, but it will give the approximate answer only. Don't go for that. Now, to solve this illustration, if you are being given scientific calculator, no problem. So I'll just change the calculator into scientific format. Scientific calculator. Here, third root. Third root given here or not? No. As third root is not given, you can calculate this way. 1.331 to the power 1 by 3. 1 by 3. This is the answer. Okay. This is the answer. Then minus 1. You'll get the 0.1 directly. 0.1 direct. Is that clear? If you have the scientific calculator, you can get the answer, or you have to depend on the log. Okay, by applying the log, you can solve this illustration easily. If you don't have the log, if you don't have a scientific calculator and all, no other information, the shortcut being this one, trial and error method. For examination, you can use the trial and error method comfortably, because for the CA foundation, CMA foundation, math is all about MCQ questions. In MCQ questions, how many options are there? Only 4 options. Guess the answer could be one of the 4 options. Okay. Is it 10%, 9% or 11%? Calculate using all the numbers, you will get the answer directly. So no need to panic for your examination. Clear? Sir, how can I guess, sir? Only 4 answers are there. You can use all the 4 numbers here, get the answer, finish off that. For your foundation exams. In practical life, what I do is mental calculations. The mental calculation is based on this one. It's 11%. Cumulatively 11%. Definitely it will not be 11% in case of simple interest. I just adjust this, maybe 10%. That's how I'll adjust in my life for my calculations and all. Because for fraction of second, if you are going and watching the shares price movement, okay, wait sir, I'll calculate the interest rate hidden here directly using the calculator. That's all. The next moment the rate may be changing in the stock market. Fraction of second. Every second there will be change in the price in the market. By the time you need to have the thumb rule to calculate the answers easily. Thumb rule means a shortcut. What I'm guiding you here is also shortcut. Clear? Hope so you could understand. Clear? Now what happens? This will be resembling like WDV method of depreciation. WDV method of depreciation. This formula will be reversed in case of rate of depreciation calculation under the WDV method, where 1 minus nth root of scrap value by original value. In case of compound amount, you are adding. In case of depreciation under WDV model, subtracting. Everything put in the other way. Okay. Minus becomes plus, plus becomes minus. Future value is scrap value there and original value. The same formula is put in a different way for the calculation of rate of depreciation under WDV method. WDV method. Is that clear? So these two are interconnected. These two are interconnected. Come on, make a note of it. Now, see that 0, 1, 2, 3 principal value and future value. What is the rate of interest? That rate of interest, will be equated with the growth rate. Will be equated with the CAGR. CAGR. So if I want to calculate the rate of interest, the formula being nth root of future value divided by present value minus 1 is the formula. The I is otherwise named as growth. In case if I invest 100 rupees, applicable rate of interest being 10%, what about the future value? That's how you can calculate for amount of investment. Okay, amount of investment. Rather than today we have population 1000, growth rate of population or interest rate of population. How will you say? In case of population, you will use the G, growth rate of the population being 2%. What about the future population? So I can be interchangeable into growth where I is not applicable. Clear? Not necessarily only being I, it may be G also. Sometimes you can use CAGR also. The term CAGR represents the growth rate. CAGR. Compound annual growth rate. Okay. Compound annual growth rate. Indian economy, earlier it was a billion economy, now it's a trillion economy. From billion to trillion, it took around so many years. What is the CAGR? That's how it will be asked. Okay. Now, CAGR of India. So 8.2% over the last 10 years. GDP of India grow at the rate of 8.2% every year for the last 10 years. Okay. 10 years ago, if it is being 1000, what about today's GDP in India? 1000 into 1 plus this G will be taken to the power 10. That's how we can calculate. CAGR is nothing but same interest rate calculation. Predominantly, the CAGR is used for nation's GDP rate calculation and all, right? It was 8.2 over the last 10 years. However, CAGR for the GDP per capita is estimated to 6.2 per capita. Okay, overall GDP divided by the number of population, the population we have in India, per capita income. So India is a 4 trillion, it's a trillion economy. Okay, trillion economy. Though trillion economy, Indian population will not be comparable with some other rich countries. Okay, their economy is lesser, but the people are richer because their net worth GDP may be around billion, but the population very lesser, 10 lakhs and 15 lakhs. Their per capita income is higher. But for 150 crore population, the trillion economy seems to be small, peanut like. Still, we have to grow further. Is that okay? So, for all this calculation, GDP per capita and all, we can use. So, currently what? CAGR through 2033, at this rate, we can reach 1.8 trillion by 2033. Okay. So, that's how we can calculate. If today's economy is a trillion, within how many years I will get double or triple? Use the CAGR, that same interest rate. Rather than stating this being the interest rate, if you are stating this for CAGR, you are most educated person in the society. Go and see and talk hereafter. Sir, CAGR is 7%. The layman will get confused. Oh, something he learned new. But CAGR is equal to what? Normal rate of interest only. Otherwise named as growth rate. Is that clear? But this rate is applicable for this GDP and GDP per capita calculation and all. So you'll study all these things in your macroeconomics, right? Hope you'll be now able to understand this logic. So that's how you can guess if Indian economy grows in this angle, what would be the future economy of India compared to the other nations. Okay, see, this is how they will guess. CAGR of India 8.2%. What about the China? Okay, the China CAGR being in the last 10 years 7.5, and over the last 5 years it's 6. See, last 10 years 7.5. The last 5 years it's only 6, means there's a dragging down, reducing, and 5.2 over the last 3 years. In the last 3 years only 5%. Clear? These are the interesting factors you can use in your practical life. Let's see. CAGR of India being 8.2 percentage, China being how much? Latest being only 5.2. Latest being only 5.2. And what about the economy? Economy. Okay. Economy of China. Okay. List top 10 economies in the world 2025. United States almost 30 trillion, China almost 20 trillion, India 4 trillion. Now India is the fourth largest GDP countries in the world, right? Fourth largest. Now this is being 4 trillion, this is being 20 trillion. Comparing to India and China, the China being 5 times larger, approximately 5 times larger. Now the question is, shall I able to be surpassing their own growth rate or not? You have to go and verify. Their growth rate is at the rate of 5%. Our growth rate is at the rate of 8%. Their growth from 20 trillion, they are growing at this rate, 5%. We are growing from 4 at the rate of 8%. At what time we will be matching with them and what time we will be surpassing? Okay. Sir, all these things we cannot calculate. So no problem. We will have the Excel sheets and all. You can put that value here, right? Now let's see. China, okay, 20 trillion. India, 4 trillion. Okay, China and India. Okay. Now every year the growth rate being how much? 1.05. 5%, you know, 1 plus I only now. Rather than it's 1 plus I, it's 1 plus CAGR. Okay, then it will be 1.05 per year. 1.05. This is what about the growth of China's economy every year. Okay. Should be number. It seems to be not number. Now you'll get the answer. Okay, I'll just remove this. Okay. This becomes 20 at the rate of 5%. It becomes how much? 21. Okay. In India, with this, you have to multiply with what? 1.08, 8%. Clear. Now I just continue this for around 50 years. 50 years will continue this way. Okay, 50 years. This is how the economists also analyzing the uh, growth and other thing. Yeah, maybe this is 2025. Now, in which year we are matching? The next year, China will have 21, we have 4.32, and that's how it's going on. Currently, the difference. Okay, you can also understand this one. This is the difference. So, now, yeah, so gradually increasing. By 2072, this is how the difference appears. Now, let us go further. Sometimes later, when by which year? 2082, we are closer to whom? China's economy. In the next year, 2083, we cross Chinese economy. Will you exist? I'm not available, sure. Okay. 2083. Still, how many years we left with? 25, almost. How many years? 68 years still we have. 60 years we have to go. You add today's age, and with that, definitely you will be the global leader. You will be leaving India in the world when the India being the global leader. But not necessarily it's a 5 and 8. That 5 sometimes may go 4, 3. But Indian economy may go from 8, 9, 10 also. Who knows that? You have to add other parameters also. By the end of 70th year, definitely will surpass China as per the current status. But because of the other factors also, we may reach or surpass Chinese economy matter of 30 or 40 years. That's how we can predict. This is how we can predict. For all these predictions, we need to understand the time value of money. I can ask ChatGPT. What happens? Using the current, okay, current GDP and growth rate, CAGR, when will Indian economy surpass okay huh? That will understand, don't worry. Economy, huh? I'm typing already with lots of fighting. Yeah? Okay. So now it will calculate. So China's projected GDP being 5 and then 4, it will go down like this. What they are using here again, the time value of money, what we are studying here. Year to close gap 81 years. We got around 70 years. GDP, the chat GP is giving us 81 years gap. By the end of 81 year, we will surpass China's economy. Oh, that points to around 2106 for India to catch up the China's nominal GDP, assuming growth trends hold steady. The growth trend we used 5%, they are using the same 5%. The 5% not necessarily 5% hereafter. It may be 4 or 3 because of the other factors also plays a role. What if we look GDP PP? Okay, you can even reach within couple of decades we can reach. So some other points also be considered here for the calculations here. Hope you will be now able to understand the importance of time value of money. Within how many years you can become crorepati? Use the time value of money. Of course, you can use the time value of money to become crorepati also. At what time I can become crorepati? I can always go by Benz, not in Singer Academy's Benz. Rather than sitting over a Singer Academy's Benz, you can then go for buying a Benz car and all. So for all these things, this CAGR calculation will be okay. Anyhow, rate of interest is equal to the growth rate. The same is applicable for the nation's growth, means economy purpose. We use the CAGR. For all these things, the base is I only. Clear? Now let's see. Under compound interest, for calculation of future value and compound value, compound amount, this formula will be applicable. For the present value, the same formula is used in the reverse manner. Also, we have studied this one or this one. And for the I calculation, okay, for the I calculation, we use the same formula, slightly modified, and we got this formula. The I will be sometimes used for the growth calculation. The same I can be used for the CAGR calculation for sometimes later for economy. Hope now you'll be able to understand all these logics. Yes, finish of copying this, then we'll move on to the next illustration. Rate of interest growth CAGR under compound interest model. Hope now you'll be able to understand the connection among the three terms: rate of interest, growth, and CAGR and compound interest are both are same but termed differently. The term rate of interest is used for what? Amount where the bank gives interest and there is a growth. Growth can be used for population and other cases. Population, food growth, and unemployment growth rate, and employment growth rate, millionaires growth rate for all. Indian economic growth rate, CAGR. Is that okay? Inflation growth rate. For that also you can use the growth rate. Let's see in this illustration. SSA purchased a bond for ₹1,000 maturing in 3 years. 0, 1, 2, 3. 1,000 maturing in 3 years. After 3 years, SSA received a total of 1,500. What was the interest rate for the loan? What is the interest rate here? You have to calculate the interest. So we have been given 3 data: P, F, N. It's your duty to calculate I. So already told you we can use a rough estimation, trial and error method. A real formula being this one: I is equal to nth root of future value divided by present value minus 1 is the formula. But the nth root, the third root, we cannot calculate using the non-scientific calculator. So rather than using this formula, then we can go for rough calculation. 500 rupees is the interest, right? 500 rupees is the interest for how many years? 3 years. Then per year is this one. Probably 167 roughly for your investment of 1,000. So 167 for 1,000, it's roughly 16.7 or 17% or 16%. As it's being the compounding method, the real rate of interest may be less than that. Probably we'll start with 14%. 14, 15, 16, 17 like this. Should be closer to 16%. So the formula being F is equal to P into 1 plus I to the power N. 1 plus I to the power N. N is 3, or N is equal to F by P. Here 1 plus I being missing data to the power N is 3. F being 1,500, P being 1,000 is equal to 1.5. So 1 plus I to the power 3 is equal to 1.5. Now I assume some numbers as I is equal to 14%. 1.14 to the power 3 is equal to 1.5. Come on, what's the value for 1.14 to the power 3? 1.14 to the power 3. 2, 3, 1.48. 1.4815. 1.4815. 1544. So not the answer. So now the value is lesser. I have to raise this to 1.5. So you have to now rise from 14 to 15%. If the I is equal to 15%, 1.15 to the power 3 is equal to 1.5. Is it so? Come on, check. 1.15 into equal 1.520875. 1.520875. Also not answer. So 14% it seems to be lesser, 15% seems to be higher. The required answer should be anywhere between these two, maybe 14.5 or 14.3. If you are being the CA Foundation, CMA Foundation students, go and see the MCQ question. So you can easily solve this illustration. Now Srimati has given the answer. Anyhow, I'll just try to solve this one. So for 14%, my answer is 1.481544. For 15%, okay, my answer being 1.520875. Now see the interpolation technique. Under interpolation technique, as I am changing just 1% in rate of interest, the change in future value is how much? Come on, the difference between these two. Difference. Yeah. What's the difference between these two? 0.039331. Now, what's my requirement? It's not 1.48, it's not 1.52. It should be anywhere between these two. In between. I need this one, 1.50. From here you calculate. What is the difference? Zero point 0.018456. It means I need 0.018456 change. Because of changing 1%, the change happens being 0.039, but I want to make a change of 0.01 only. So you can do the cross multiplication. While doing, you can take this value. Which value? Lower value, and then apply this one directly. That's what about the interpolation technique. So 14 plus this value 0.018456 divided by 0.039331 into 1. Okay, so what you have to do? Lower number and higher number. We determined that the required number should be anywhere between these two. Once it is over, from lower to higher, 14 to 15, by changing 1%, the change in amount being 0.039331. But my requirement being this one, the difference between these two. I need only this much change. So from the base minimum value, apply this formula directly as a cross multiplication. Find out the final answer. Come on. 14.47. 47 or 5 may be the round off. So rounding up, there may be, of course, rounding off error. It may be 14.47%. Now let's try. Will I get this answer or not? If the rate of interest being 14.47%. 1.1447 to the power 3 is equal to 1. Are you getting this answer? Come on, tell me. Okay, 1.1447 to the power 3, power 2, power 3. Almost 1.4999 round off. If you are rounding off, then this value will be equal to 1.5. So 1.1447 4999 is equal to 1.5. Sorry, this is 1.5. Of course, matching. Otherwise, slight difference 1.448 or 1.445, like that will be slight change. Means a higher number may be possible. Hope you will be able to now guess the exact answer using what? Rough calculation, interpolation technique. Interpolation technique. Clear? Hope now you will be able to understand this. So 14.47. So Srimati has given the answer correctly using the trial and error method. Of course, you don't need to worry about the log method or other methods or application of scientific calculator. Nothing required. For your examination, shortcut is this one. You follow this one. Once it is clear, text me. Ninth question. Now we have to calculate the n, number of years. Under simple interest, it is very simple. But in compound interest, you have to go for lots of calculations. SSA invested 1000 in a deposit at a 10% compound interest rate, and SSA received a total of 1500 after a certain period. What was the duration of the deposit? 0, 1, 2, n. I am not sure with the number of years here. Present value 1000 and future value being 1500, and rate of interest being 0.1. Now my requirement is to calculate n. Right. See here. F is equal to P into 1 plus I to the power n. F is 1500. P is 1000. 1.I being 1 to the power n. Otherwise, 1.1 to the power n is equal to 1500 divided by 1000 is equal to 1.5. 1.1 to the power n. How can I calculate? It's very simple, right? See, 1.1 to the power 2. Power 2 I get 1.21. Power 3 I get 1.331, which is closer to 1.5. Power 4 1.4641. So 1.1 to the power 4 is equal to 1.4641, which is not equal to 1.5. I'll go for again power 5. It's very simple. 1.1 to the power 5 is equal to 1.61051, which is also not equal to 1.5. So from this, it's very clear. It should be anywhere between 4 to 5 years. 4 to 5 years. 4 to 5 years. In the fourth year, together with the rate of interest, it becomes the 1 rupee becomes 1.4641. For fifth year, it becomes 1.46, but I want exactly 1.5. Then you can use the interpolation. For using the interpolation, rate of the number of years and the future value. If the number of years being 4, the value being 1.4641. If the number of years being 5, the value being 1.61051. And the difference being just 1 year extra, the difference in future value being, come on, 0.0. Okay, 14641. But my requirement being only 1.5 in between. That value will be calculated. What's the value? 0.0359. I need only this much change. For 1 year change, my future value increases by 0.14641, but I want only 0.0359. Then you can use the cross multiplication. So here you have to take the lower number and then you apply this one. You have to add with that. Okay, lower number being 4 plus you are going to include this one, 0.0359 divided by 0.14641, and the change being only 1. Then what is the ultimate value? 4.22. 2 for 5 years. So 4.245 years, otherwise 4 years. How many months? 0.245 may be converted into month. How many months are there? 0.245 into 12 months. Come on, what's the value? 2.94 month. 94 month. Or you can do this way. What is that? 4 years, 2 months, 0.94 month. 1 month is equal to 30 days. 28 or 28 days. So either you can say 4.245 years or 4 years, 2 months, 28 days. How can you convert everything into month and day? After the 4 years fraction, you know 0.245 years, 0.245 years converted into month by multiplying with the 12. This will be multiplied with the 12. This one 0.245 year is converted into month by multiplying with the 12 months. Then you will get 2.94 month. That 2.94 month, I need to know the days. So 2 months separate. That 0.94 month will be converted into days by multiplying with the 30. So 28 days. Even 2 days extra will make it 3 months. Now let's see cross verification. Of course, with this answer is arrived. You finish up with this. For the cross verification for the 0th period, present value being 1000, you are getting interest. How much? Interest for the first year 10% 100. This is future value by the end of first year 1100. For the second year, you have to calculate interest for this at the rate of 10%, which is 110. So 1210 future value for the second year. Interest for the third year, for this again you have to calculate 10%, which is 121. 1331. This is future value 3. Add interest for the fourth year, for this 10%, 133.1. So 1464.1. This is future value by the end of fourth year. Now add interest for roughly 3 months. Roughly 3 months. Isn't it? So roughly 3 months means 1464.1 into 10% for the whole year. But now I had to calculate only for the 2 month 28 days, or you can multiply with the this one. Okay, into 0.245 year. Come on, get me the value here. The fourth year, I need to calculate interest for the fraction year. 0.245 years interest I have to calculate. What is the value? 35.87 or 9. Come on, add this. So you'll be getting exactly 1500 by the end of 2 years and 3 months. 2 years and 3 months. Hope so you will be now able to understand. So you don't need to use other tough calculations. Use the trial and error method. You can decently get all the answers for your exams, right? Come on, recap all these things. We'll meet after a break. Now, one of the beautiful concept here, rule number 72 and rule number 69, for finding the doubling period approximately. Actually, in practical life, we will not depend on all these tricky calculations, but we need to get the answer faster. So we may have our own thumb rules. So as I already told you, for 10%, how much money will be my profit over some period. That all these things are calculated by mind itself. I never depend on the calculators. So that is called thumb rule. We don't have the clear measurement, but we can call this being the thumb rule. Right. For example, 0, 1, amount invested at the current period being 1, and in future it becomes 2, at the rate of interest being 10%. Now find out the N. Find out the N. It is called doubling period. If I invest 100 rupees, within how many years I will get 200 rupees at the rate of 10%? If that question is there. Yeah, of course, earlier we calculated the N. N is calculated this way, right? 1 plus I to the power N is equal to F by future value divided by present value. We now substitute the different year, 4th year, 5th year, that's how we'll calculate. And in case of doubling period means F by P is equal to 2 rupees. Future you will get 2 rupees, today you invest 1 rupee. The 1 rupee becomes 2 rupees. Now the rate of interest being 10% means 1.1 to the power N should be equal to 10, should be equal to 2. In trial and error method, how can you calculate 1.1 to the power 2 is equal to this one, 3, 4, 5, 6, 7. 7th year almost closer to 2. 8th year is more than that. So it should be anywhere between 7 to 8. Probably 7.3, 7.4 will be the answer. That's how you can calculate using the trial and error method. But in case of doubling period, we have the shortcuts. We have rule number 72. Rule 72 says doubling period is equal to 72 divided by rate of interest. That's all. That rate of interest should be in terms of absolute sense. In this case, 72 divided by the rate of interest being 10, the final value being 7.2. So we already guessed it should be anywhere between 7 to 8 years. By using this thumb rule, we get the doubling period being, the N being 7.2 years. Right, this is not correct one, but approximately closer number. To get the exact number, there will be lots of calculation. You have to depend on scientific calculator and all. In order to simplify and get the answer quickly, if of course there may be slight error, I will accept that. In that case, we use rule number 72. Rule number 69. Rule number 69. Okay, this is more refined. Rather than rule 72, if you use rule number 69, it will be giving you more accurate answer. But predominantly we follow only rule number 72 because 72 has more factors. Can be divided by 1, 2, 3, 4, even 5 you can get the answer easily. 6 also can use for dividing, and 7 you will get a fractional number. 9 also applicable. But 69, it seems to be a fractional number. We cannot use multiple factors here. 1, 2 cannot be. 3 okay, 4 again trouble, 5 trouble, 6 trouble. So many troubles are there. So only we depend on rule 72 rather than 69. Both the rules are simple only. 69, rule number 69 gives you more closer answer. Rule 72, yeah, of course, slight deviation from the correct answer. Maybe slight error will be there. But anyhow, I can calculate mentally. The mental calculation will be very simple in case of rule number 69. In case of rule number 69, the doubling period is equal to 69 divided by rate of interest plus 0.35. So this one will be added further. So in this case, 69 divided by rate of interest being 10% plus 0.35. Then final answer being 7.25. So you will now see the difference between these two. A slight higher value is there. This may be more closer. This is less closer. But both are inaccurate only, not accurate one. Not accurate one. Both are inaccurate only. Is that clear? So as per now, understand that doubling period calculation under rule number 72. Rule 72. The doubling period is equal to 72 divided by rate of interest. In case of rule 69, the doubling period is equal to 69 divided by rate of interest, sorry, number of years plus 0.35. That's all. Now see, if the rate of interest is 5%, what could be the doubling period? Under this model, 72 divided by 5, the final answer being 14.4 years. In 14.4 years, you will get the amount doubled. Okay, under rule number 69, 69 divided by 5 plus 0.35, 14.15 years. So within 14.15 years, you will get the amount doubled. You can cross check. These things you can try in your own home. Play with the numbers for some time. Play with the number. See, 1.05. This is what about, sir? This is what about the value I am going to start with. Into equal is equal to the power 2, power 3, power 4, power 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. By the time of 14, you will be closer to doubling value. How much is that? 1.9799. This is what about the future value by the end of 14th year, and present value of the 0th period being 1. This 1 became 1.9799 in the 14th year. And for a few more days, 1.9799 for this 5% for 0.15 year. For 0.15 year. What is the value you are getting? 0.0148. Come on, get me the answer. One point 96, 98. You have to add 99 47, almost closer to 2, or you can take 0.2. 0.2 may be very closer answer, but definitely if you use 0.4, the answer is very bigger. So from this it is very clear, this answer may be very closer. If I use this answer, what happens? 14.4 years. 14th year, my value which is invested the 0th period 1 becomes 1.9799 plus interest for the 0.4 years here. So 1.9799 into 0.05 into 0.44 years. Come on, get me the value. 0.0435. What is the total value? 0232. Okay. Okay. So almost both are closer to the required answer only. This 14.15 is much refined one rather than this one. The answer could be anywhere between these two numbers. So for the doubling period, you no need to use the calculators. Simply use the 72, rule 72, 72 divided by the rate of interest, you will get the doubling period. Roughly, you will get the doubling period. Okay. See, my uncle was the advisor for post office investment schemes and all. Asked me to join with him for explaining the post office schemes to one of my colleagues. Okay. So my colleague usually puts lots of questions usually. My uncle told him, if you start invest 550 rupees every month for 5 years, you will get 40,000 rupees. That one my information was in my mind. What could be your usual question? Okay, you need to know how much you have to invest to get your desired amount. You want to purchase a car, Tata Nano car, by the time 1 lakh. How much I have to invest so that I will get 1 lakh by the end of 5th year? Immediately, those calculation, you know that insurance advisors, post office scheme, investment scheme promoting advisors and all, they will have a log book, like they will actually go and refer that book and tell. My uncle started referring. You want 1 lakh? Okay, I'll refer. Then immediately I told it may be around 1,400 rupees. Then the next one, if I invest 2,000 rupees, how much I will get? My uncle again started going for watching. Wait. Immediately I told, if you are investing 2,000 rupees per month, you may be roughly getting around 1,50,000 rupees. My uncle got stunned. And after coming out from the discussion, he asked me, how can you tell all the answers? I am telling only roughly. If it is going wrong, who cares? By the end of 5th year, he will also forget. Anyhow, my guessing is almost closer. If you invest 550 every year, matter of 5 years later, per month for 5 years, you will get 40,000 rupees. See, in your non-scientific calculator, 550 per month. For 12 months, roughly this is the value. For 5 years, this becomes 33,000, but 40,000 is the statement because of the interest component. My friend asked about what about the investment requirement if I want 1 lakh rupees by the end of first year. So just do the cross multiplication. Roughly, it's 2.5 times, right? So definitely this should also be 2.5 times. 2 times 1100, another half 275. I no need to have what? Calculators. 1400 rupees roughly. Then next question, if I invest 2000 rupees, how much will I get? Roughly, this is 4 times. And roughly, this is also 4 times, 1,60,000. But it is not 4 times, less than 4 times. So the answer should be anywhere between 1,50,000 to 1,60,000. I started giving the answers using the mental calculation. After returning from the discussion, my uncle asked, how did you know all this? Nothing is there, nothing. Everything is simple. Money matters. All these things are money. Okay. You are able to understand the logics. See, if you are investing in the stock market, the change of the price based on these calculations. So, what happens if the profit earned by the company increased from 100 to 105? 5% increase. Then what could be the price change in the market? 5% should be up. The sudden calculation, everything you can apply practically to handle the finance much better way. Anyhow, I have given here small shortcuts. So you will now understand what is the logic behind the thumb rule. Thumb rule is nothing but a shortcut. Will it be accurate? Definitely not so. But reliable, of course, for the fast calculation and immediate decision making, this one will be reliable. Okay, usually just go and interact with your parents. The famous thing is, if I invest 1 lakh, within how many years I will get double? How much I will get? Within how many years I will get double? That's the main question. So hereafter, what is the rate of interest, sir? It's around 8%. 72 divided by 8, 9 years. Within 9 years, you will get double. Fraction second, you can tell your suggestions to your friends and relatives who are in need of investing. Doubling period. So doubling period, 2 formats are there. Rule 72, Rule 69. As per rule number 72, the doubling period is very simple, 72 divided by the rate of interest. That rate of interest should not be in decimals, in absolute term. Doubling period in respect of rule 69, 69 divided by the rate of interest, don't forget to add 0.35 with that. That's all. Clear? Now, question number 10. At 5%, at a 5% annual interest rate, how many years would it take for an investment to double? Doubling period. So doubling period, if you use the rule 72, 72 divided by rate of interest. We have already completed 72 divided by 5, 14.4. And in case rule 69, 69 divided by I, 0.35. Okay, already we have completed. So 69 divided by 5 plus 0.35, the value being 14.15. We have already done this. Clear? Now, 11th question. At a 5% annual interest rate, how many years would it take for investment to 4 times in a value? 4 times, 4 times. So, as per rule number 72, you will get the doubling period. What's that? 72 divided by rate of interest. This is what about the doubling period. So, 72 divided by 5 is equal to 14.4. This will be for doubling. Now you have to calculate 4 times. For 4 times, what happens? Again, it should be doubled. Again, it should be doubled. So, another 14.4, 28.8 years. Okay. Clear? 1 rupee becomes 2 rupee. Now, the next question, 2 rupees becomes 4 rupees. For 1 rupee becoming 2 and 2 rupees becoming 4. For this, it is 14.4 years. For this, it is 14.4 years. Overall, 28.8 years. Is that clear? If you apply the rule number 69 here, the answer being n is equal to doubling period being 69 divided by rate of interest plus 0.35. Okay, 69 divided by 5 plus 0.35 is equal to 14.15. For 4 times, you have to double this, so 28.30 years. Is that clear? 11th question is over. Shall I move on to the next one? So the 4 times value calculation is nothing but it's a 2 times of doubling. 1 rupee becomes 2 rupee. It's a doubling of this one, right? 2 rupees becoming 4, also another doubling. This is doubling number 1, this is doubling number 2. For doubling of your investment, you are in need of 14.15 years. From 2 to 4, again one more doubling. For that also, we are in need of 14.15 years. In a matter of 14.15 years, the amount invested 1 rupee becomes 2 rupees. And another 14.15 years, this 2 rupees becomes 4 rupees. If you are comparing the 1 becomes 4, how many years happening? Then you have to add up these two, which is 28.30 years. Is that clear? Hope now you'll be able to understand. We'll move on to the next illustration. Twelfth one. At a 5% annual interest rate, how many years would it take for investment to 8 times in value? 8 times. So what happens? 0. Here 1 becomes 2, 2 becomes 4, 4 becomes 8. So this is one doubling period. This is doubling period number 2. This is doubling period number 3. Clear? Okay. Rule number 72. Doubling period is equal to 72 divided by rate of interest. The value being 14.4. Here 14.4. From 2 to 4, we have taken one more doubling period requirement 14.4. 4 to 8, one more doubling period. Then what's the overall value? 43.2 years. Is that okay? Srimadi, be careful. So rule number 69, so you're making slight mistakes here. As per rule number 69, n is equal to 69 divided by rate of interest plus 0.35. 69 divided by rate of interest being 5% plus 0.35. Hope this value being 14.15. From 1 to 2, this is 14.15 if you are using the rule number 69. From 2 becomes 4, it's also one more doubling. 2 becomes 4 is one more doubling. For that, we are in need of 14.15. This 4 becomes 8. That requires one more doubling period. So 14.15. So the ultimate value being 40, 42.45 years. Is that clear? No, you should not multiply with the 2. Okay. You have to multiply 14.15 with 3. Is that okay? How many doubling periods are there in 8? How many doubling periods? Okay. So, divide this by 2, 4. Again, divide this by 2, 2. Okay. This is like 2 to the power 3, like. That's how you can get it. So, you can understand the logic this way. First doubling period, 1 becomes 2 for this one doubling period. 2 becomes 4, second doubling period. 4 doubles 8 in the third doubling period. For every doubling period, we are in need of only this much. Okay. Clear? Shall I move on to the next one? Question number 13. Now, future value for different rest period. X Limited offers FD scheme whereby 10,000 matures 12,544 after 2 years on yearly compounding basis. What will be the revised maturity value if the company wishes to amend the scheme by compounding interest on half yearly, quarterly, monthly, daily, and explain compound annual growth rate also. So we have to solve all these things one after one. So the calculation of interest using the formula is very simple. Nth root of future value by principal 0th period value minus 1 is the interest calculation. This formula can be used where the n being root based 2, 4 like. Okay, in those cases we can usually calculate, otherwise we have to go for trial and error method only. So in this case, the hidden rate of interest being second root of future value being 12,544 divided by 10,000 minus 1. Then I think this value being 0.1, otherwise 10%. So at the rate of 10% compounding yearly, your 10,000 becomes 12,544 over 2 years period. Clear? 12%. Okay. Yeah. 12%. 0.12, otherwise 12%. Is that clear? At the rate of 12%, the investment becomes 12,544 over the 2 years period. Clear? But yearly rest means interest will be calculated for the first year, for the next year. Principal with the first year interest together, on that you will calculate the second year's interest. That's a concept. Shorter rest period. Sir, will I get the interest for every 6 months and compounding interest on that every 6 months later? Oh, okay, of course we can do. That will be called as shorter rest period. If nothing stated, usually rest period being yearly. Sometimes the company may offer, the bankers may offer. So we have the short rest period, sir. Rather than yearly compounding, you will be getting half yearly compounding, monthly compounding, quarterly compounding. How can we calculate this? A slight modification in your formula. So your future value is equal to present value into 1 plus I to the power n. This formula is slightly modified. Okay, how? Future value is equal to present value into 1 plus I divided by number of rest periods. M represents number of rest periods in a year to the power number of years multiplied with the number of rest periods. NM. Is that clear? So future value is equal to present value into 1 plus I divided by M. Number of rest periods to the power number of years into number of rest periods. In case of half yearly, what is the formula? Half yearly. Right. The formula being F is equal to P into 1 plus I divided by 2 rest periods. Half yearly means how many rest periods are there? In a year, 2 rest periods are there. So 12 divided by or 1 divided by half. Okay. 1 divided by half. So you'll get 2 rest periods. That's what about M. How many times you are getting interest accumulated over the 1 year's period? So half yearly one, sir. First half year you will get the interest. For that also you will calculate interest for the second half year. So 2 times. To the power 2 years multiply with the number of rest periods. So P being 10,000. Then 1 plus I being 0.12, 12%, right? Divided by number of rest periods being 2 to the power 2 years into number of rest periods in a year being 2. So the final answer being 10,000 into 1.06 to the power 4 times. Clear? Clear? Now 1.06 into power 4, no, power 2, 3, 4. 1.2624 I multiply with the 10,000, then final value being 12,624. 12,624. Point, what's the other value? Yeah, 7. Clear? Hope now you'll be able to understand the calculation of compound interest calculation in case of shorter rest period. Shorter the rest period, most beneficial for the investors. See, year on year accumulation of interest gives you 12,544 only. Rather than half yearly once means you'll be getting how much? 12,624. Almost 80 rupees you are getting excess. Because first half year interest, for that second half year itself you will be getting interest on interest. Clear? So you can calculate this way also as a manual one. 10,000, a normal understanding. This is what the principal value, interest for the first year at the rate of 12% being 1,200. This is first year end. Then interest for the second year at the rate of 12% on this being how much? 1344. And future value by the end of second year 12,544. Now what the bank offers is quarterly rest period for interest credit. Sorry, half yearly, okay. Half yearly. Now find out the interest for half year. Yearly 12%, am I right? For half year it should be 6%. Now P is equal to 10,000 minus interest for the first half year, 6% is 600, 10,600. This is what about the future value by the end of 0.5 year. Add interest for the second 0.5 year. How much? For that 6%, 636. This is future value by the end of first year being 1,136. 236. This is higher than this version. Because of the quicker accumulation of interest. Then add the interest for the next half year on this at the rate of 6%. Come on, tell me. 674. Add that, you will get the future value by the end of 1.5 years. 11,910. And again add the interest for the next half year at the rate of 6% on this. Come on. 715. And what about the future value by the end of second year? 12,625. See, compared to this, you will get almost 80 rupees excess. 80 rupees excess. Is that clear? But rather than calculating this way, okay, what you can do? You can simply apply the formula. The formula for the revised case. Okay, shorter rest period. The formula being future value is equal to present value into 1 plus I by number of rest periods. Rate of interest 12% per annum, but I need to calculate the amount of interest only for the half year rest period. Then what is the rate of interest for the half year? 12 by 2. So yearly 12 means half year you will get 6%. To the power, how many such rest periods are there? Half year. So in 2 years, how many half years are there? 4 half years. So that may be mentioned this way. N is the number of years and number of rest periods in a year. That's how you can convert that formula. Of course, you don't need to use the formula. You can use this way also. F is equal to P into 1 plus I divided to the power M. N. That formula itself we can use for the every period separately. In this case, I is equal to 6% and N is equal to 4. That's how you can calculate. By the time also, you'll get the same answer. So here I represents interest rate for the every rest period. Here N represents number of rest periods in the tenure. 2 years, how many rest periods are there? 4 rest periods. 4 rest periods. If I have quarterly, what happens? In a year, you have to calculate 4 times, and in 2 years, you have to calculate 8 times. Calculating this model will be time consuming. That's why we have to depend on what? Formula. Let's see. This is not required. This is for understanding what happens. But actually, we have to study only this one. Okay. So this is for understanding purpose only, not required for your exam purpose. You can use the formula here directly. Okay. Now B. What is that? Quarterly. Okay. Quarterly basis. Okay. The formula being the same one. 10,000 into 1 plus rate of interest per annum being 0.12. 12% per annum, but quarterly means how many quarters there are there in a year? 4 quarters. So divide that by 4. So from this it is very clear. For every quarter, the interest amount will be 3% only. 3% only. To the power, how many rest periods are there? In a year, 4 rest periods. For the 2 years, 8 rest periods are there. 8 rest periods are there. Come on, tell me the value here. 10,000 into this value. Okay. Yeah, 1.12 divided by 4. This is the interest for the rest period plus 1 to the power 8. No, so into power 2, 3, 4, 5, 6, 7, 8. So 1.26677. 1.26677. Finally, the answer being 12,667 or 68. Now, as the rest periods is very shorter, the amount you get will be higher. You will be getting higher. Okay. If you are getting the interest accumulated year on year, okay, you will be getting lower money. If the interest accumulation is quarterly ones or half yearly ones or daily ones or monthly ones, it will be more beneficial. It will be more beneficial one. Further, of course, you have to depend on the formula directly. You can apply this way. Now, in case C, monthly basis, monthly basis, 10,000, 1 plus rate of interest 0.12 per annum. How many months are there in a year? 12 months are there. So you have to calculate interest for per month to the power 2 years into how many months are there? 12 months in a year. So number of rest periods being 12. Then final answer being 10,000. Yeah. So 1.01, right? 1.01 to the power 24 into equal power 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24. So the value being 1.26973. Okay. 1.26973. If I multiply with the 10,000, the value being 12,697.3. So among all the models, shorter the rest period being the monthly gives me more revenue. Lots of banks will confuse you. Okay, lots of banks will confuse you for borrowing as well as for investment. A bank will say, I will give you 12% rate of interest. The another banker will say, I will give 11%. But the 12% wala no, he gives 12% of interest once in a year. But 11% I am giving every month. Now you got confused. Which is superior one? 11% of 12%. Isn't it? So one fellow says 12% per annum. Annual rest period. Annual rest period. Another fellow says 11% per annum, but monthly rest period. They will now tempt you to invest in our company. So, Bank A says, sir, I will give you 12% per annum, sir. Yearly rest period. Another fellow says 11% per annum, sir, but monthly. See, quicker rest period. Now, where do you want to invest? Wait, sir, my teacher is just now teaching me. Once he completes the syllabus, I'll come back. Huh? So, if you invest 1000 rupees, what happens? In this case, future value is equal to principal value into 1 plus I to the power n. Principal value 1000 and the rate of interest being 12% to the power n being only 1 year. So, 1120 will be the return. Under the second scenario, future value is equal to P into 1 plus I divided by M to the power Nm. P is 1000, 1 plus I being 0.11 divided by number of rest periods in a year being 12 to the power 2 in 1 year the next. Okay, so it should be 1 year, so 1 into 12 will be the answer. 1 into 12. Now you can use the calculator. 0.11 divided by 12, add 1 with this to the power 12 into equal power 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Okay. And you get 1.11571. With that, if you multiply with 1000, the ultimate value being 1115.72. So naturally what happens, this is superior. The marketing people will market the product easily. Sir, that fellow gives you 12% only once in a year interest, sir. Our company will give the interest for every month. This is superior. You need to know which is superior. Unless you know the exact calculation, you will be losing the money. In practical life, you will be losing the money. Is that clear? Very interesting, right? So, in case of compounding, we have the shorter rest period. Shorter rest period is more beneficial. So, the bankers will play this way. Sir, we will give shorter rest period, but very lesser interest. Another fellow says, we will not give short rest period, only once in a year, but the rate may be higher. Now, you have to compensate. Which is better? You have to calculate in comparable manner. Only then you can compare and tell the answer. Clear? Hope now you'll be understanding the logic here. So we have completed what? Half yearly rest period, quarterly rest period, monthly rest period. Okay, now I'm going to calculate daily rest period. Daily rest period. In case of daily rest periods, what happens here? The formula being F is equal to P into 1 plus I divided by M to the power N into M. P being 10,000, 1 plus I being 0.12. Now daily means how many rest periods in a year? 365 days to the power 2 years into how many rest periods are there? 365. Then the final value being 10,000 into this one. So you have to calculate this value. Of course, calculating in your non-scientific calculator is a punishment. So don't worry about that. So it will depend on the scientific calculators. Okay, it's a punishment. So 0.12 divided by 365, you will be getting the interest per day. This is what about the interest per day. You have to add 1 with that. So you will now get the bracket value, the value in the bracket, which is 1.000328 will be the value. To the power 730 will be taken. So to the power, this is the power symbol, 730. So this is the value, 1.271199. So you have to multiply with the 10,000 to arrive the final value. So the final value being 12,000 12,711 point or 12. We can round up to the next higher number. Daily compounding is much better. Daily compounding is much better. Clear? Daily compounding is much better. See, yearly compounding gives you only 12,544. Because of half yearly compounding, you get bit higher. Quarterly compounding still higher. Monthly compounding still higher. Daily compounding is much better. Sir, rather than daily compounding, sir, will I get the interest compounded hardly, sir, every year? Sir, when will the class get over, sir? I have to run out of this class. Huh? For every minute, for every second, that is called continuous compounding for every second. But surprisingly, for the daily compounding and continuous compounding, instead of this formula, we can use a shortcut. Okay, the formula in this case being P e to the power IT, rate of interest into term. This is the formula used for what? Continuous compounding or daily compounding. If I am getting interest hardly, how many hours there in a year? 365 into 24, so many hours. So interest divided with so many number. So much of confusions. So instead of that, you can use simply P into e to the power IT. E is a constant number. Like pi. What is the value for the pi? 22/7, right? Isn't it? Similarly, it has the value. E also has a value. 2.72. Okay, like. So, anything power 1 will be its own value. So 2.7182 will be the value. This is what about the value for the E. Is that okay? So usually in your examination this value will be given. No need to worry about that. E to the power, the value will be given. So principal F is equivalent to this value. So future value is equivalent to present value 10,000 into e to the power IT. E to the power I being 0.12 per annum, T being 2 years. Otherwise, e to the power 0.24. Okay, you have to find out the value for e power 0.24. Usually, in your exams, the e power 0.24 value may be given. If you go and refer, see a text there, you will have appendix and where all this value may be available, you can pick from there. Anyhow, here I directly go for scientific calculator. Okay. So what is that? E power 0.24. 0.24. Okay. So this value being 1.2712. Okay. 1.271249. 1249. If I multiply with the 10,000, then the value will be 12,712. You get the same answer. But of course, calculation of this one is really tough. Daily compounding is not required for your examination. Is that clear? Instead of that, you can memorize this formula. P into e to the power IT can be kept in your mind. That may be quite easy. Where e to the power IT value may be given in the examination. So you have to find out e to the power 0.24. They may give in your examination e to the power 0.1 this value, e to the power 0.2 this value, e to the power 0.3 this value. But you have to calculate for e to the power 0.24. You have to search that number and fix it here. That's all. In your examination. Clear? Now, what about the last one, sir? Explain compound annual growth rate, CAGR. CAGR is nothing but this one only. Daily or continuous compounding. Clear? Hope now you'll be able to understand here. See. Under compound interest model, I guided you this one. S is equal to P into 1 plus I to the power N for finding the future value. I guided this one. If future value is given, how can you calculate the present value? You have followed this one. In case different compounding periods, shorter or different, rather than yearly compounding, it may be totally different. Yearly, half yearly, quarterly. Then the revised formula will be this one. P is equal to 1 plus I divided by M to the power Mn. So we have completed this formula. So this one also completed. And in case of daily or continuous compounding, we have the shortcut, which is nothing but P into e to the power it. T represents year, but here I use the term N. N also can be used, no issues. T represents the term, time only, no, here N. And we have completed this one also. So only one thing is left over to be discussed with respect to the compound interest, being this one. Clear? Get ready for the revision now. So before I go for the last one, let me finish up the revision so that you will be master with all these things. Then we'll proceed subsequently. Let me know once you have copied this. I will go for the revision, and then the last component of compound interest will be completed. Come on, make a note of it. Now, effective rate of interest. A borrower offers 16% nominal rate of interest with quarterly compounding. What is the effective rate of interest? That's a question. C, interest rate per annum being 16%. Interest rate 16% per annum. And quarterly compounding. Then future value is equal to present value into 1 plus I divided by number of rest periods in a year to the power number of years into number of rest periods. We assume that the principal being 100, as it is not given here, 1 plus I being 0.16 divided by 4 rest periods, as compounding period is quarterly, 4 rest periods to the power number of years assumed to be 1 into number of rest periods in a year being 4. So then the ultimate value being 1.04 to the power 4. Come on, tell me.
1.16.
Okay. 2, 3, 4. 1.1698. If I multiply with 100, 116.99. 116.99. Okay, this is what about your amount in future. Now listen, a company says to you, it's a quarterly compounding and 16% per annum. Now another company says my value being annual compounding. Okay. So rather than quarterly compounding, if it is being annual compounding, what should be the interest so that I will get the same return? What should be the interest so that I will get the same return? 100 becomes 116.99 means 16.99 is your return interest. What is your interest? You will be interest rate 16.99 you are getting for your 100 rupees investment over 1 year. It means 16.99%. So 16.99% will be the answer. 16% per annum but compounded quarterly will give you a return which is equal to 16.99% getting annual compounding. So if it is being the annual compounding, your future value is equal to P into 1 plus I to the power N. P being 100, 1 plus 0.1699 to the power N being 1 year, then the ultimate value being 116.99. So that's how you can cross check. Okay, a company states that 116% per annum quarterly compounding should be equivalent to 16.99% per annum yearly compounding, both are same. Yearly compounding, both are same. Is that clear? Company A says 16% per annum but quarterly compounding. Company B says annual compounding but your yearly rate of interest being 16.99. But absolutely these two are same. These two are same. This will be called nominal interest rate. This will be called effective interest rate. To find out the effective interest rate, we have a shortcut here. Effective interest rate is equal to, okay, 1 plus nominal interest rate. 1 plus nominal interest rate divided by number of rest periods to the power number of rest periods minus 1 will be the answer. So 1 plus 16 percentage is nothing but 0.16 divided by 4 rest periods to the power number of rest periods being 4. From there you have to subtract minus 1. Then what's the value you are getting? Okay, 0.16 divided by 4, okay, to the power plus 1 to the power 4, power 2, power 3, power 4 minus 1, you will be getting 16.0.1698, otherwise 16.98 percentage, slightly different. So you get lots of interest rates. If you want to borrow or if you want to invest, you are inquiring about the investments and returns from different banks. Every bank will tell different rates, stating our compounding period is different. Then you will be totally confused, because it's how they cheat. Okay, they want to promote literally. So company A says, sir, my rate of interest being 12 percentage, compounding rest period being yearly. Another fellow says 11.8 percentage, half yearly rest period. Another fellow says 11.5 percentage are quarterly rest period. Another fellow says 10 percentage are daily rest period. Now you got confused. Which among the four will be most chosen one for you? Among the four, which is the best one? You get confused. So all the rates they have given here is the nominal rate. You have to convert that into the effective rate. If the rest periods being 1, what could be the rate offered by them? So you have to convert all these rate to the effective rate. For the conversion of effective rate, the formula being effective rate of interest is equal to 1 plus nominal interest rate divided by number of rest periods to the power number of rest periods minus 1. In the very first case, 12 only, so it remains 12. In the second case, 11.18, right? So 1 plus 0.118 divided by 2 rest periods to the power 2 minus 1. Come on, tell me what's the value here? 0.118 divided by 2 to the power plus 1. Okay, 2 to the power 2 minus 1. This is 12.1214 or 12.14, 12.15. Okay, 12.15 percentage. This one is 12 percentage. The next one, in this case, 1 plus 0.115 divided by 4 rest periods to the power, how many rest periods in a year? 4 rest periods minus 1. Here what happens? 0.115 divided by 4 rest periods. Add 1, you have to consider fourth power of this. So into equal power 2, power 3, power 4 minus 1, this value being 12 percentage. So this is 12 percentage. Okay. And daily compounding, of course, you have to use P e to the power it minus 1. That's how you can use this. It or in or simply e. Okay. E to the power it minus 1. So e to the power 0.1 into 0.1, rate of interest is 0.1. That's all. Into 1 year only, no. So you have to calculate this. You have to subtract minus 1. No other way. You have to depend on scientific calculator. So e to the power 0.1 minus 1. So the ultimate value being 10.52. 10.52 percentage. So if the lender offers you these rates of interest for your borrowings, or offers you these types of interest revenue for your investment, you have to be double cautious, no? If I invest in your company, what's the rate of interest you'll give, sir? Mr. A will come, salesperson for company X. Sir, all the banks will offer you 12 percentage. but they are paying interest only yearly once. But our company pays interest daily, sir. You get tempted. Oh, daily interest? It seems to be superior than that one. So I'll just go and invest here. But if you are investing in this last one, actually your return is only 10.52. So you convert all the nominal rate of interest to the means effective rate of interest. Based on the effective rate of interest, you can rank. This is the first rank. I know this is 12 point some fraction number is there, so second rank. This is third rank. This is the fourth rank. That's how you can decide which among the four item will be giving you more interest. If you are being the borrower, you have to go for this one. First rank, second rank, third rank, and fourth rank. This is for borrower. This is for investor. But being the investor, you need to get more interest. For the borrowing, you need to get lesser interest. For all these things, you have to calculate effective rate of interest. For the calculation of effective rate of interest, you need to have this formula. You need to have this formula. Is that clear? Okay. So here in simple interest, I have given this point here. Effective rate of interest, EA is equal to 1 plus I by M. The I represents nominal interest divided by M to the power M minus M into N minus 1. Formula is already given. So up to now, we have completed simple interest as well as compound interest in all cases. Clear? Now, summary. Under simple interest case, the formula is very simple. Future value is equal to present value plus interest. To calculate the interest, we can get this way. Interest is nothing but PNI. This can be calculated the other way, P plus PNI, or you can show the P may be outer one, so 1 plus NI. These are the way you can handle this. That's all. This is what about the simple interest. What are the mode of question you can expect for any given value? You have to find out the future value or rate of interest or number of years and all. You can calculate on all these cases. Is that clear? N and all. In case of compound interest, future value will be this way. P into 1 plus I to the power N, and present value is equal to F divided by future value divided by 1 plus I to the power N, or F into 1 plus I to the power minus N. Even sometimes you need to know how to calculate what? Rate of interest. For the calculation of rate of interest, the formula being nth root of future value divided by present value minus 1. This I will be sometimes named as G, sometimes named as CAGR. Okay, all are same only. Is that clear? And in case of compound interest, you need to understand the difference between effective rate of interest as well as the nominal rate of interest. In case of effective rate of interest, the formula will be 1 plus nominal rate of interest divided by number of rest periods to the power number of rest periods. From there you can subtract the 1. Okay. So here only you have to understand the concept called shorter rest periods. Okay. In case of continuous compounding or daily compounding, the formula may be quite bit different. E is equal to P into E to the power rate of interest into the number of periods or term of the investment. Even you can calculate the P. P is equal to F into E to the power minus IN. These two are predominantly used most of the forex calculations at final level. Here you are going to understand this one, but you are not going to apply this in detail at your inter or foundation level. All the illustrations for the forex calculation, we have to depend on this model only at the final level, not here. All the content what I have taught you since the morning are only this one in a different angle with lots of variations we have studied. Most probably, in case of interest or N calculation under compound amount model, we preferably use trial and error method. In case of doubling period under compound amount, doubling period, we can use rule 72 and which is 72 bar I, and rule 69. Rule 69, which is equal to 69 divided by I plus 0.35. This is what about the number of years required for doubling the investment. Is that clear? Okay. So assets now have completed almost 14 illustrations. Simple interest as well as compound interest. Still, we have to cover annuity, sinking fund, and annuity. So these things are going to be covered. Okay, future value annuity, present value annuity, and perpetuity. If we are covering those things, then time value of money will be completely over. But to master, you need to do lots of workings. Okay. Break, and after lunch we'll meet. So time value of money. Today's 100 is not equal to tomorrow's 100 because of two reasons. One is being the interest rate, another one is being inflation rate. In our study, we focus on interest rate, not the inflation rate. Okay. What are the notations we used in our study? Here being given in this page. P represents present value or principal. F represents future value or some money. Sometimes I may use S or sometimes it may be F. Small I represents rate of interest. Capital I represents the amount of interest. Okay. N represents number of years or periods. Number of years or periods. Sometimes the interest may be accumulated quarterly or half yearly. In that case, this N will be to the number of, means instead of taking directly N, it's N and M. Okay. G represents growth rate. Usually G can be interchangeable with the interest rate. Is that okay? And problem types, usually you may be asked to find out future value of a given number, or amount of interest applicable for your investment. And if future value is given, you have to find out the present value. Sometimes you may be asked to calculate the rate of interest. This rate of interest could be interlinked with the growth rate as well as compound amount of annual growth rate, also CAGR in short. Sometimes you may be asked to calculate the number of years. So these are the 5 types of questions you may be expected in time value of money. Right, present value or discounted value is not equivalent to the future value usually, that you can understand. And second is all about, we have to calculate all these things under simple interest methods. We have completed that. Okay. And third is all about under compound interest. If we have single cash flow, based on single cash flow, we can calculate the future value as well as present value, interest rate, number of years, everything for a single investment made today and what could be its future value in the period. So all these things we have completed. Right. And in case of simple interest, the formula being amount of interest is calculated by this way, PNI. In case of principal, some value or future value is equal to P plus PNI. And we have seen first illustration. So few illustration we have already discussed. And in case of compound interest, to find out the future value, S is equal to, or future value is equal to P into 1 plus 8 to the power N. And in case of present value, it will be shown in a reverse case, reverse angle. And sometimes you may ask, you may be asked to show the compounding period may be different than the year. Rather than yearly compounding, it may be half yearly, quarterly. In that case, you have to do an adjustment this way, 1 plus I divided by M to the power Mn. That's how you can use the formula. Slight changes is there. Right. Okay. P into, okay. And S for daily or continuous compounding case, we have the new formula called P into e to the power I n or it. Sometimes we may be given nominal rate of interest and asked to find out the effective rate of interest. That effective rate of interest can be calculated this way, 1 plus I divided by M to the power Mn minus 1. Right. So this formula you can use it. And of course, the I can be calculated using this formula, nth root of future value divided by present value minus 1. This is how we can use the formula for I calculation. Sometimes it may be called as G, where the amount is not applicable, and sometimes it may be GAR also. So these are the cases we have studied. Now we have to understand annuity. Annuity is not single payment. It's all about a multiple cash flows. Recurring deposit and all, for this will be applicable. So in this class, in the second half, we will be now dealing with the annuity stream. So rest will be the same. Right. Now, in case of an annuity, okay, period 0, 1 to n. Every year end, you invest constantly some amount P. Together with all the P's and accumulated interest on that, it becomes future value or some value. Now, if P is given, what could be the future value? Okay. When there is a equal amount spreads over a period, probably 5 years, 10 years, then it is called annuity. Annuity. You understand? Annuity is nothing but same amount repeated twice or thrice. So, or continuously for a number of periods. For n number of periods of investment, what it could be in future together with the interest. If that question asked, then this topic will be applicable. So, here f is equal to p into 1 plus I to the power n minus 1 divided by I. That's the formula, you can use it. That's the formula, you can use it. A stream of payment together with the I, how much it could be in the nth period. If this question is asked, then it is called recurring deposit. Annuity only, but a recurring deposit. It can be used for the recurring deposit. In the bank, you have various investment streams: simple interest, compound interest, fixed deposits, current account, and sometimes it may be recurring deposit. You invest in the bank month on month for a few years. So together with all the investment you have made and interest accumulated on that, what could be the nth period value? If that question is asked, especially for recurring deposit, this topic will be useful. This sum will be calculated using the formula. So a stream of payment, for that stream of payment, you have to find out the nth period value, future period value. So it's called future annuity. Future annuity or future value of annuity. Okay. Future value of annuity in short. This future value of annuity will be of two types. One is for recurring deposit. Another one is in a reverse case. I need so much money in the future. Probably 5 years later, I may be in need of 5 lakhs. How much I have to invest year after year so that I will get that so much money in the later period. So then the sum will be just inverse, right? So P is equal to F into I divided by 1 plus I to the power n minus 1. Clear? So if I constantly invest 1000 rupees for 5 years, every month 5000 rupees for 5 years, how much will I get? Recurring deposit. If I want to get 5 lakhs rupees by the end of 5th year, every month, how much I have to invest, where the investment gives me return maybe 5% or 6% per annum. So in a reverse angle, to find out the periodical payment, you have to use the formula P is equal to F into I divided by 1 plus I to the power n minus 1. This is the formula you have to use it. Particularly, this formula has a usage, especially to calculate the future value of stream of deposits. A stream of deposits P1, P2, P3, like up to Pn we have invested. For all these P's put together, what could be the future value? That will be calculated under this first model. In case of sinking fund factor, it's a reverse. To calculate a stream of deposits, that is what about P, to be made for getting desired sum later on. Especially, this will be used for two purposes. One is for replacing asset or purchasing asset, or if you borrow few years later you have to repay, so you need a lump sum amount for the repayment by the nth period. So constantly you start investing today, so in the nth period all the investment together with the interest is sufficient enough to repay the loan. So repayment of loan also be possible, repayment of loan. For these two purposes we use this sinking fund, okay, for asset purchase as well as debt repayment in future. Two predominant cases, very simple. Now, question number 15. SSA invested 1000 in a recurring deposit every year for 3 years at a compound interest rate of 10%. What total amount did SSA receive back at the end of the 3 years? See here. 0, year 1, year 2, year 3. You are investing 1000 rupees every year end. First year end 1000, second year end 1000, third year end 1000. You are investing 1000 rupees every year end. where the applicable rate of interest being 0.1, and together with all these things, what could be the future value? Okay, to find out the future value of stream of payment, we have to depend on the formula. The formula in this case is F is equal to P into 1 plus I to the power N minus 1 divided by I is the formula. Is that clear? Now, I am substituting all the available values in the formula. So, P being 1000, 1 plus 0.1 to the power N being 3s minus 1 divided by interest rate being 0.1 here. So 1000, 1.1 to the power 3 being 1.331 minus 1 divided by 0.1. Finally, 1000 into 1.331 minus 1, 0.331 divided by 1 being 3.31. Then final answer being 3310. Apply the formula, you will get the answer. So if you are investing 1000 rupees every year end, okay, for 3 years you might have invested how much? 3000 rupees. But your accumulated fund here being 3310, 310 rupees excess is there. That is nothing but your interest over the 3 years investment. Forget about the formula. Logically, a normal way, what we learn can follow here. Understand. A layman can understand, solve this illustration. So what happens here? Answer is over. Anyway, for the layman's understanding, I'll just explain the second step. This is not required. So you just follow this one itself. That's more than enough. See here now. 0, 1, 2, 3. You invested 1000 rupees here, 1000 rupees here, 1000 rupees here, where applicable rate of interest being 0.1. Now I have to find out what is the accumulated total value together with interest by the end of third year. This is the question. This is the question. Clear? Third year, the 1000 remains 1000. Third year, you invested 1000. If I verify how much I will have, only 1000. There is no any interest. You invested the same day you are withdrawing, then you don't get any interest. What about this one? For this, from here to here, 1 year happened. So you will now calculate 1 year's interest. For 1000, 1 year's interest being 1000 into 0.1, 100. So 1000 plus 100, 1100 will be the value. Last year investment remains as it is. Second year end investment becomes 1 year's, together with 1 year's interest becomes 1100. First year end investment becomes how much? You need to add 2 years interest. So at the year 1000 rupees, interest for the first year being at the rate of 10% 100. You have to calculate 2 years interest. Interest for the second year 120, 110. Okay, 110. And interest for the second year at the rate of 10% on this 110. So overall value being 1210. This becomes 1210. For all the three investment together with the interest, what's the total value? 3310. You will get the same answer. But this is normal method. What we understand, we can guess what could be the interest and all. But for if I ask you for month on month you are investing for 5 years, then automatically what happens? The first month's investment gives me 60 terms profit. Right, month on month. Okay, definitely calculating manually this way will be it's a troublesome. In order to avoid that, we can depend on the formula here. The formula being this one. So P into 1 plus I to the power n minus 1 divided by I is the simple formula to get the future value. Clear? Clear? Hope 18th one is okay. So 15th one is completed, right? Now remember, future value of annuity again, but cash flows are not even, all are uneven. All are uneven. This method will be applicable only the cash flows being the deposit being equal year after year. If we have unequal investment, we cannot calculate this way. We have to calculate only this way. Clear? Now question number 16. A person deposits 1 lakh, 2 lakhs, 3 lakhs, 4 lakhs in his deposit account at the end of year 1, year 2, year 3, year 4 respectively. So year, first year end, second year end, third year end, fourth year end. What is the amount he deposits every year? First year 1 lakh, second year 2 lakhs, third year 3 lakhs, fourth year 4 lakhs. Okay. Determine his account balance at the end of fourth year if the interest rate is 12%. What about its future value? See here. 0, 1, 2, 3, 4. He has invested 1 lakh, 2 lakhs, 3 lakhs, 4 lakhs. This remains as it is 4 lakhs. This 3 lakhs will fetch 1 year's interest. 1 year's interest means 1 plus I to the power 1. Okay. This one will have 2 years interest, 1 plus I to the power 2 years, right? Cumulative interest. This will have 3 years interest, 1 plus I to the power 3. Then get the total of all these things. Okay. This is nothing but we have studied that, no? So F is equal to P into 1 plus I to the power N. This is the formula. This part is nothing but future value factor. This is called future value factor. Is that okay? So I may use the future value factor at the rate of 12% here, future value factor, so that it will be very comfortable. In the last one, we have nothing. It remains same. So the future value factor is 1. If I invest 4 rupees by the end of fourth year, what could be its value by the end of fourth year? So the same are no interest. So it's same. So 4 lakhs into 1. If I invest 3 lakhs by the end of the third year, how much it could be in the fourth year? So 1 year's interest will be there. Then you have to multiply with this one. 1 plus I to the power 1. I here, this one to the power 1. And for the second year, we need to get 2 years interest. So then the formula being 1.12 to the power 2. The first year value for this 1 year, second year, third year, 3 years interest will be there. So the formula being 1.12 to the power 3. This is nothing but 1 plus I to the power n. Now find out the future value factor here. 1, 1.12 here being, come on. 3, 1. You give me 2 or 3 digits. 1.254. Okay. How do you get this number? 1.254. Okay. 254. And here 1.405. 405. Okay. Now find out the future value of deposit. You multiply the deposits with the future value factor. So 1 lakh into this one. This value being 1 lakh. 40,500. 2 lakhs into 1.254. 2 lakhs 50,800. And next one 3 lakhs into this one. 3 lakhs 36,000. And 1 into 4 lakhs 4 lakhs. So the total value being 11 lakhs 27,300. This is nothing but future value of the stream of payments, but the stream being uneven. If the stream being even, what you can do? You can use the formula. If it is uneven, we don't have other options. We have to follow this one only. Is that clear? Tomorrow morning at 9 o'clock, we'll be starting the practicing session on this topic. Don't miss to attend. Okay, tomorrow morning. Sir, why tomorrow, sir? Tonight itself we can fix, sir. Somebody may say. Huh? Anyhow, you plan to torture us, you torture today itself. Let the torture may end by night itself. Okay, good. So you try a lot of illustrations. Okay. This illustration, these kinds of learning only help me to understand the finance much better way. Okay. Shall I move on to the next one? Clear? Yeah, next one. Just try to close this. Now, 17th question. 17th question. SSA invested in a bond every year end. Okay. Some money at 10% amount annual compound interest rate. After 3 years, SSA receives a total of 4,641. What happens here? Year 0, 1, 2, 3. Invested in a bond. They are purchasing the bond. Okay. Every year end, some money, I am not aware about that, may be assumed to be the P value. Where applicable rate of interest in this case being 0.1. All these investment together with the interest by the end of third year, SSA received 4,641. Now you have to find out what is the P. A stream of payment. For the stream of payments, value should be calculated. So you are aware about that summation of the stream of payment along with the interest being 4,641. Now I have to find out what about the P value. What about the P value? So here P is equivalent to F into I divided by the same formula will be reversed. I divided by 1 plus I to the power n minus 1. This is the formula. I substitute the values here. F being 4,641, I being 0.1 divided by 1.1 to the power how many years? 3 years minus 1. Right. 4,641 into 0.1 divided by 1.1 to the power 3, 1.331 minus 1, 0.331. And what is the final value? What is the final value? Use a calculator. 4,641 into 0.1 divided by 0.331. 1,402 will be the answer. But how many years it was invested? After 3 years. Okay, after 3 years. So 1,402 will be the answer. Clear? 1,402 will be the answer here. Now, listen. This will be used for what? Two purposes. Sinking fund is used for two purposes. One is purchasing new assets sometimes later or replacing one of the old assets after the expiry of the asset's life. Or borrowings may be repayable sometimes later. So repayment. So these are the two cases. These are the two cases. Asset purchase as well as repayment. We understand that we are in need of 4,641 rather than I just do means add two more zeros. I supposed to purchase a car for rupees 4,64,100 when few years later. Exactly by the end of third year. By the end of third year. I want to purchase a car for 4,64,100 by the end of 4 year. So I am earning money for it. Every year I may invest. some bonds or some post office schemes, saving schemes or bank. That bank gives me a return of say 0.1 per year. Now my question is, how much I have to save per year? Save per year. Seems to be a logical, practical life question. Okay, for this we are going to use the same formula. See here, 0, 1, 2, 3. I need to purchase the car for rupees 4,64,100 by the end of third year. I need to set aside some amount of mine for purchasing the assets, which gives interest at the rate of 10%. Over the 3 years period, I will get this one. Then my question is, how much I have to invest every period end so that these investments together with interest, I will get this value. 4,64,100. Is that clear? So naturally, what happens? This resembles like this one. Okay. So the amount to be invested every period is equal to F into I divided by 1 plus I to the power n minus 1. Everything is ditto. Between these two, only 2 zeros extra. Then 1402. With that, add 2 more zeros. So I have to invest so much money every year so that by the end of third year, I will get 4,64,100, and with that, I can go on purchasing the asset. Or I have the borrowings. That borrowings will be repayable by the end of third year at the rate of rupees 4,64,100. For this also, this money will be useful. Just to see, 1,40,200 you invested every period for 3 years. How much you might have invested? Come on, tell me. 4,26,600. But you are getting how much by the end of third year? 4,64,100. How much additional you are getting here? 43,500. Is it so? Okay, 43,500. This excess amount will be called as your benefit or interest. Interest. See what happens in your bank. Very first year you invest. First year. Principal at the first year end being 1,40,200. Okay. Next year you are visiting the banker and you inquire what is the amount I have, sir. The banker says, sir, for first year means year 1 to 2. You will be eligible for interest at the rate of 10%, so 14,020. If you go and verify the balance available in your bank account, you will find that the balance being 1,54,220. Second year came, this year again you want to invest another amount. Second year, how much? The same 1,40,200. So from this it is very clear, every year you visit the banker and deposit, come back. And next year go and verify what's the balance you have, additionally invest the same amount. So second year end, you invested that, so automatically this becomes 2,94,420. Now in the third year you are going, by the time interest will be for this year 2 to 3. The banker will give interest for this year at the rate of 10% being 29,442. Together with how much you will have in your bank account by the end of third year, come on. Okay, 3,23,862. Now P3, you want to go for the last investment. The last investment being 1,40,200. That's all. You immediately withdraw this. What is the total amount now you have? 4,64,062. So the required money is now arranged. There is a slight rounding of error because of that 38 rupees difference is there. That's the process you do. The important of sinking fund method is nothing but whatever the assets you supposed to purchase later on, suddenly purchasing is really tough. Rather than that, so you plan how much you need. For that, every year how much you can keep it aside from your savings or your salary, so that sufficiently you can accumulate the fund to purchase the asset. Even in case of borrowings also, you can repay comfortably with that small savings you do. Sinking fund is one of the beautiful chapter. Earlier, for the depreciation, we had depreciation chapter. As per the depreciation chapter, whatever the depreciation you create, no, not only that, you have to deposit that amount. This amount will be deposited every year. Now that syllabus is not. That is not in your syllabus, now cancelled. So earlier, WDV method, SLM method. Apart from that, we had sinking fund method of depreciation. Under sinking fund method of depreciation, not only we depreciate, what we do usually, asset value is depreciated, decreased due to the depreciation, that amount is debited to the P&L account in balance sheet, asset value will be decreased. Is that okay? This is the normal process you do. Okay. Okay. So asset value being 1 lakh. This year you are supposed to depreciate 10,000 rupees. Then the balance of the asset appears in the balance sheet being 90. This depreciation is debited to the P&L account. That's how you do. Under sinking fund model, asset account 1 lakh minus depreciation 10,000, 90. This depreciation is charged here. Not only that, investment is made to this extent. So this will be named as sinking fund investment rather than depreciation. In your balance sheet, how much you have? Same 1 lakh. Gradually, this value will be decreasing. Gradually, year on year, this value will be increasing. The moment this value is no more worth, scrapped, you throw off that sufficient amount is already available, use that for purchasing the new one. So, beautiful depreciation strategy. Today, we don't have such strategy, but I follow this in my practical life. Whenever I start purchasing a new asset, always I will be double cautious. At the end of the lifetime, I need to have sufficient money to replace. Okay, so many my friends and relatives will ask, so you are spending lavishly, but you're verifying whether spending 500 rupees seems to be worth or not so many times. I spend 1 lakh rupees also, but this spending is very question mark. The main reason is this 1 lakh is one time, once. This is recurring per month. I concentrate on this controlling this recurring expenses, not this one. If I purchase a bike for 1 lakh, okay, immediately I think how much I need to spend every month for the bike purchase. If the bike purchase costs me 2,000 rupees per month, my income should be sufficient enough to accommodate this 2,000. Not only that 2,000 rupees, after some years later, I have to repurchase this. No, for that, another 3,000 rupees I need to have in my car, in my pocket. Unless I have the regular income 5,000 rupees, I don't purchase the bike. Though I have 5 lakhs rupees in bank account. Whatever the asset I purchased, for that running expenses, in case to replace, how much I have to set as it, that amount should also be available per month to be deposited. Unless I have this money, I don't purchase. Because you have to be very careful for the regular expenses. This is only one time. Forget about that, but it is a regular. Regular will be pinching your pocket always. So you have to be double cautious. Month on month, whether you have the money or not, you have to pay. So I may be asked from my relatives also to invest in LIC as well as mutual fund or some recurring deposit. My first answer is no. See that it will be very useful for your savings and your future life. No. Okay, of course, savings is useful. I'm talking about the same. And they also discuss with me. You are the trainer for financial management and you know much better me. That's why I'm not investing in the recurring deposit now. Why? Whatever the recurring deposit may be, LIC may be, all these things are again, of course, my asset only in the future. For that, I'm committed to pay 500 rupees, 1,000, whatever it may be, LIC premium or monthly installment. Now, month on month, I have to work for this, which is not possible. Do I want to work for this? No, I'm not full. Then what will you do for the future, sir? Whenever I get surplus money, I don't want immediately that 1 lakh or 2 lakhs, immediately I blocked in new investment, big investment. Okay. So I prefer share investment, investing in the share because I know how to handle the shares. So I invest whenever I get around, if I get 50,000 rupees immediately, just go and purchase this. My friends and relatives ask for this one, but I say no because I'm not an employed, regular employed person. So I'm not drawing the salary. If I'm being the salaried person, every month I may be getting 50,000 rupees or 1 lakh. After spending every month, I can pay 10,000 rupees. Being the business person, I cannot guarantee that I will get the fees regularly every month. At the time of admission, I will get the junk amount. Thereafter, I don't get any amount. So I have to spread over the entire investment throughout the year. So recurring is always a tension. Recurring is always a tension. Clear? So for all these things, these are the logic. Sinking fund as well as means recurring deposit factor. Both put together, future value annuity. What are they? Okay. These two. Calculation of S, recurring deposit. Calculation of P is sinking fund factor. Calculation S is nothing but future value annuity. These two put together will be called as future value annuity. Is that clear? Any doubts? Shall I move on to the next one? Second session is much faster. We'll finish off everything easily. First half is very, very important, where I discuss the logics and concepts. Here it's not required that much, right? Now, rate of interest, question number 18. SSI invested 1000 every year for 4 years. After 4 years, SSI received total 5 lakhs. What was the interest rate for the investment? Now, interest is missing. What about the timelines are here? 0, 1, 2, 4th year. Every year you are investing 1000. Only 4 years, no. Year 3, year 4. Is that okay? Together with all the investment and interest applicable for this, I am not sure with. I'll get 5,000 rupees. Now my question is, what is this interest? What is this interest? Is that okay? Now, for investment 1000 each, 4,000 rupees becomes 5,000. I earned a decent profit of 1000 rupees over these 4 years period. Clear. Amount of interest, no problem. But I want to calculate what is the rate of interest. Apply the formula here. Future value is equal to present value into I divided by, into 1 plus I to the by 1 plus I to the power n minus 1 divided by I is the formula. Okay. P in this case being 1000. I in this case being to be calculated. F is 5000. F is 5000. Now 1 plus I to the power n being 4 minus 1 divided by I. I can name this being future value anti-factor. Future value anti-factor. So future value anti-factor is equal to 5000 by 1000. Otherwise 5 is the answer. Future value anti-factor should be 5. Now you have to find out the future value anti-factor here. Future value anti-factor here. Now, how to calculate this? No other way. You have to assume yourself different I's. I may assume I may be equivalent to around 12%. If I being 12%, what is the rate? I substitute in this formula 1.1 to the power 4 minus 1 divided by 0.1 should be equal to 5. Come on, cross check. 1.1 to the power 4 minus 1 divided by 0.1. One second, nonsense. 1.1 power 4 is nothing but into equal power 2, 3, 4 minus 1 divided by 0.1. This value being 4.641. 4.641 is equal to 5. Is it true? No. Definitely it is not answer. So this 4.641 should be increased to 5. Okay. To increase this, you have to increase the rate. Okay. Whenever you want to increase the output under future value factor, you have to increase the rate of interest. If you want to increase in case of discounting the reverse, the rate will be minus. 12, 10. Okay, here future value. So 12, 14, 16. That's how you can go. Even 12, 13, 14, 15 also you can use. Now let's go for I being 14 percentage. If I being 14 percentage, 1.14 to the power 4 minus 1 divided by 0.1.
1.127.
Huh?
1%, 10%.
Oh. I used 10 percentage. Okay. So 1.12 to the power 4 minus 1 divided by 0.12 is equal to 5. Come on, get me the value. Thank you. Okay. 4.779. Of course, not equivalent to my required answer. I'll now go for 14 percentage. Let's check whether it will match the 5 or not. 1.14 to the power 4 minus 1. Okay. See, 1.14 power 2, 3, 4 minus 1 divided by 0.1. The ultimate value be
4.8. Sir, 0.14.
okay. I missed this. 4.9 to 1. 4.921 not equal to 5. Here divided by 0.14. I should be 0.14, right? Definitely we have to go for other number. So I should be equal to 16 percentage. We can try with 15 percentage also. I'll just directly go for 16 percentage. Then it will be 1.16 to the power 4 minus 1 divided by 0.16 should be equal to 5. Now what's the value?
5.0664.
So 1.16 into equal will be the power 2, 3, 4 minus 1 divided by 0.16. The ultimate value being 5. Okay. 5.066. Also, this is also not matching. Anyhow, one smaller number, one bigger number we found out, then required answer should be anywhere between these two. That can be calculated using the interpolation. For the calculation of interpolation, I being 14 percentage and where your future value anti-factor being 4.921. If the I being 16 percentage, your future value anti-factor being 5.066. Making 2% change, what could be the change here? 0.145. But my requirement is anywhere between these two. My required answer is the actual future value factor required being only 5. And how much I have to change here? 0.079 need to be changed. I need to change only this much, 0.079. So 2% increasing the interest rate, 79. Okay. 2% increasing the interest rate makes a change of 0.145, but I want only from 4.921 to 5. Means 0.079 should be changed. For the interpolation technique, you have to take with the base value and this will be cross multiplication. This will be cross multiplication. So the value being 14 plus 0.079 divided by 0.145 multiplied with the 2. Come on, get me the value. Okay, 15.09 percentage. Okay, can we cross check whether this answer is correct or not? Substitute in the formula. If you are substituting 1 plus I, 1.1509 to the power 4 minus 1 divided by I being 0.1509. Come on, get me the answer for this. The I what I have calculated, with that your solution is over for the examination purpose, but for cross verification whether this answer is right or not, you calculate the future value factor using this, you will be getting
4.9.
5, almost closer, 1.15 0.9 into equal power 2, power 3, power 4 minus 1 divided by 0.1509. So the answer being 4.999 can be rounded up to 5. Is that clear? Hope our answer is correct. So as I already told you, you no need to depend on log or some other method. You can very easily calculate here using this logic. Is that clear? Okay. Make it faster. Make it faster. Now, a variant here. 19th question. 19 and 20 both are variant in the same topic. With that, future value annuity will be over. After future value annuity factor, we have to go for present value annuity factor. With that, entire chapter is over. Clear? Text me, online students. Now, future value annuity. Payment in advance. Usually, annuity means the payment should be in arrear. 1 year end, second year end, third year end. Why? If you are employed anywhere, you earn the money, use for your requirement. Anything left over in the month end, you can invest. Right? That's the logic. Similarly, you do the business, earn the money, spend all, year end, whatever the profit you left over, out of that, a share can be invested. So, usually, when we think about investing for the future requirement, we invest by the year end. Rather than that way, sometimes the investment may be made ahead. That's a rarer scenario that may also come. Usually, anti-factor, we start invest year after year, year end. But sometimes if it is year beginning, how the sum will be. Very simple. Let's see. SSC invested 1,000 in a recurring deposit every year beginning for 3 years at a compound interest of 10%. What total amount did SSA receive back at the end of the 3 years? So what happens here? Year 0, 1, 2, 3. 1,000 rupees is going to be invested in a recurring deposit periodically. Every year beginning. Beginning is the matter. First year beginning is nothing but today itself. Second year beginning is the first year end. And second year end. 3 investment. Okay. Where applicable rate of interest being 0.1. Okay. 10%. What about its F value? Okay. So you know that future value of annuity is calculated this way. F is equal to P into 1 plus I to the power n minus 1 divided by I. Is that okay? But in case in advance, you have to multiply this with 1 plus I ahead. One extra interest will be there. See, if it is being this way, 0, 1, 2, 3, investing here, you will get 0 interest, 1 year interest, 2 years interest. Instead of that, if you are investing here, for this you will get 1 year interest, here 2 years interest, 3 years interest. Compare these two, naturally you will be getting 1 year's interest excess for all the 3 investment. So for all the 3 years information, what you calculate, you have to multiply with 1 plus I for 1 year additional interest. That's all. Now you no need to worry about making up this formula. It's very simple. The normal future value anti factor, what you take no, with that you have to multiply with 1 plus I. That's it. Come on. Formula being 1000 into 1.1. I being 0.1. So 1 plus 0.1, 1.1 multiplied with 1.1 to the power 3 minus 1 divided by 0.1. 1000 into 1.1, 1100 into this value being 1.1 to the power 3, 1.331 minus 1 being 0.331 by 0.1. So 1100 into 3.31, multiply these two, 3641 will be the final answer. Is that clear? Hereafter all these things are very easy. Very toughest and challenging part is the second one, compound interest factor. Here it's a variant only, just that's all. There you have studied only one investment. Here we are studying a stream of investment. 19th one is also over. Online students, come on, text me so that we'll move on to the next one. Question number 20. Question number 20. Future value of annuity where uneven cash flow is there. That too payment in advance. Is that okay? A person deposits 1 lakh, 2 lakhs, 3 lakhs, and 4 lakhs in his deposit account at the beginning of every year. Is that okay? So year 1, 2, 3, 4. What about the deposits you do every year? 1 lakh, 2 lakhs, 3 lakhs, and 4 lakhs. 1 lakh, 2 lakhs, 3 lakhs, and 4 lakhs deposits. In all the 4 years, year 1, year 2, year 3, year 4. Determine his account balance at the end of 4th year if the interest rate is 12%. Then you need to have what? 12% future value factor. Future value and factor. Individually you have to calculate. Isn't it? 0, 1, 2, 3, 4. Investment being 1 lakh, 1 lakh, 2 lakhs, 3 lakhs, 4 lakhs. Come on, tell me. For this 4 lakhs, how many days interest you have to calculate? 1 year. For this, 4. Then here it may be 1 plus I to the power, I being 12% to the power 4. Here 1.12 to the power 3. Here 1.12 to the power 2. Last one being 1.12 to the power 1 or simply 1.12. Yes. This value being 1.574. This value being 1.405. This value being 1.254. Finally, it is 1.12. Now, future value of deposit. Multiply these two to get the future value deposits. 1 lakh into 1.574 being 1,57,400. 2 lakhs into this one, 2,81,000. And here 3,76,200. Finally, here 4 lakhs 48,000. Overall total being 12,62,600. This will be the future value of your stream of investment. Shall I move on to the next one? So with that, future value annuity factor is over. Clear? Okay. So for this, you are going to mug up only one formula. Okay. For recurring deposit, this one is the formula. For sinking fund, inverse of this one will be the formula. In case advance payment, the same formula, you are including this 1 plus I along with the formula itself. That's all. These are the three variants. That's all. Yes, in this illustration, it's all about 1 plus I only. 1 plus I only. 1 plus I to the power 1, 2, 3, 4. Okay. The I being 12 percentage. So as we are studying the advanced illustration, I just directly add the 12 percentage along with. Okay. It is always 1 plus I. You don't need to follow the procedure method given in Singer Academy text. That's the only guidance. You can follow your own method. Now let's move on to the next one. 21. We have few more. Okay. Few more, probably 6 more illustrations. With that, all the illustrations are over. Right. We'll now deal with a new concept called present value annuity. Earlier we studied the future value annuity. Here we are going to study present value annuity. In case of present value annuity, see, every year end you get 1,000, 1,000, 1,000 and 1,000. Usually what could be its total value together with interest in the future? That's the question. Am I right? In case of present value annuity, for all these value put together along with interest, how should be by today's value? By today's value. What is the today's value of 1,000? This 1,000, this 1,000, this 1,000, and some make the summation of all the four. That will be the value we are going to calculate here. This is called present value annuity factor. Now, for the present value annuity factor, the formula is S is equal to P into 1 plus I to the power n minus 1 divided by 1 plus I to the power n into I. This is the formula. This is the formula. Especially, why do I want to calculate this one? You need to understand, no, the application of this formula. How long will you be effective for working in your life? What about your parents? They will now start telling, if you go for employment, I may get retired. But we never allow fathers to get retired. Isn't it? Is that no? So the same happens. When do you want to get retired? When you have sufficient money to take care of your remaining life, then you will be happy to retire, right? Probably 50, 60. Why? By 40 or by 30. So I am very happy, sir, if I get retired in the next month itself. How much will be your monthly expenses? Sir, my monthly expenses is around 10,000 rupees. If I want to get 10,000 rupees year after year until my death, when will you die? Then that question comes. If there is Second World War, Third World War, no problem. It's guaranteed, matter of another 4 or 5 years. If there is no World War and medical advancement, then you will live for 100 years also, who knows? But huge expenses there. If I retire today, thereafter I want to get 10,000 rupees month on month until my death, or I just keep my death day being 100th year, age being 100. Would you like to live beyond that? Yes or no? Sir, if time permits, okay, sir. If ever fate permits, then I'll live beyond that one also, sir. Right? 100. I need to get 10,000 rupees every month after my retirement up to my date of death. Probably You retire by 50 and you die by 100. Okay, I die by 100. So why do we talk about dying, sir? Talk about living. Okay. So if I want to retire by 50th year and I may expire, my expiry date may be 100. Assume. Sir, you are so means over enthusiasm, sir. You will live 100 years. No, sir. Don't desire so much, huh? Okay. You need to get every month 10,000 rupees for another 50 years. 50 years. Otherwise, 600 month. Every month you need to get 10,000 rupees. So much money you need. How much? 60? Do you want to have 60 lakhs? At the time of my retirement? No, it may be 30 or 40 lakhs is more than enough. Because that amount will fetch me interest also, right? That is going to be calculated. I deposit 60 lakhs today. I keep 60 lakhs in the bureau. Every month I can take 10,000 rupees and spend my remaining life. I am very happy until my death. So interesting. Then I need to have 60 lakhs. Why do you want to have 60 lakhs, sir? You can deposit in the bank, that will fetch you interest. Oh, is it so? Then I no need to invest 60 lakhs. I need to have only 40 lakhs or 35 lakhs. Now my question is how much I need to have at the time of retirement so that month on month I may consistently get a pension like. So for the pension fund, this method is useful. All of you during the retirement, means during the effective life, you think about sinking fund, future value annuity. Because if I invest how much I will save to buy a car and to buy a bungalow and all, for that we use the future value annuity factor. After my retirement, how much I have to keep so that I will get my pension regularly up to my death safely. That part will be coming here. Interesting, no? So, birth to death is over with this time value of money. Clear? So earlier we thought about savings money for purchasing the assets. Now we are planning for dying. Huh? A decent dying. Okay. So actor Rajesh once gave the interview. I constructed my own cemetery. Huh? Cemetery where I can die. So beautiful cemetery where I die. Kallarappa. I constructed my Kallara myself, cemetery and all. Okay. While purchasing for my wife, I purchased for me also. She expired 10 years ago. So I purchased mine also. Decent one. So everything is again planning. Everything is also planned here. Planning about the pension will be a part of present value of annuity. So beautiful concept. So the present value annuity is to calculate sum required at present for getting annuity. Annuity is nothing but periodical payment, probably pension. Probably pension. Is that okay? And sir, the formula seems to be pretty massive. Do I want to mug up this one? Especially for the present value of annuity, you no need to mug up this formula. I will explain that. See here. I'll try to solve the illustration here. If SSA receives a yearly pension of 10,000 at the end of each year for 3 years, what a compound interest rate of 10%, with a compound interest rate of 10%, what was the total amount of money SSA had at the beginning of the first year? Okay, 3 years. So what happens? He gets 1,000 rupees every year end. Pension, like I need to get 1,000 rupees every year end for the first year end, second year end, third year end. How much money I need to have today for all this put together? Where the applicable rate of interest being 0.1. I need 1,000 rupees in the future, so 3,000 rupees. But today I have means definitely it will fetch interest, so I no need to you means invest 3,000. It may be less than 3,000. Now the question is, what should be that money? Use the formula. Here the formula being P is equal to periodical value into 1 plus I to the power n minus 1 divided by 1 plus I to the power n into I is the formula. Periodical payment being 1,000, I being 10%, so 1.1 to the power n being 3 minus 1 divided by 1.1 to the power 3 into 0.1. Okay. Now the numerator value 1.1 to the power 3 being 1.331 minus 1, 0.331, 0.331, denominator value being 1.1 to the 1 to the power 3 being 1.331 into 0.1 being 1.331 into 1000. I think this value being, come on, 0.331 divided by 1.331. Come on, make it faster. I think this value is wrong. Okay. 0.1331. This value being 2.486. 486 is the answer. So then what happens? 1000 into this value being 2486. Okay, round off this. If you have 2486 today, this is sufficient enough for getting 1000 rupees every year for 3 years. You invested 2486. In the future 3 years, you will be withdrawing 1000 together with the interest. Then it becomes 0. So you are getting 3000, but you are investing 2486, almost 514. 514 rupees you are getting interest additionally. C. Logical calculation. At 0th period, you invest how much? 2486. Okay, this much you have. For this period, you get interest. Am I right? Add interest for the year 1. How much? At the rate of 10% on this, 248.6. What's the final value? 2734.6. Immediately, for your requirement, you are withdrawing 1000 minus drawings. After drawings, you have 1734.6. Again, add interest for the next year. After that, whatever the balance left over now, you will get interest for this period. For this, 10% being 173.4. Now the value being 1908. I round off this to 1908. Now I withdraw this amount minus drawings. I end up with 908. This 908 in the bank. Up to the 3rd year, you will get one more interest for the balance left over. So add interest. The interest being 91. So the ultimate value being 999. The 3rd drawings will be 1000. Almost nothing is there. Happy, no? So you need to invest. The last question is very, very interesting question. I'll ask this question during the break. You can try it yourself. Okay, what's that question? You're supposed to work. I will put the question here. You can take your own time and you will get the answer. I think you will start working for your employment at your age 20. Okay, 20 or 25? 25, okay. So until that, I will disturb my parents. Good. And you thought to work for up to 60. Okay. Thereafter, how long would you like to live?
Sorry.
For safer side, 100. Sir, enough, sir. 70, sir. 70, sir. Now, I need to get the pension here. How much? How much pension do you want? Don't expect as a beggar. At your age 60, 50,000 rupees may be useful for purchasing only cup of coffee or tea.
5 lakhs.
4 lakhs. Okay. I make it 1 lakh. So decent calculation. Or 10 lakhs. Okay. So I'll live a royal life after my retirement. So 10 lakhs per month. 10 lakhs per month. For how many years? From 60 to 100. Thereafter, whether you live or not, you have to go out. Now my question is, this is what about your retirement life? This is what about your working life? For retirement life, you need to invest, right? Now the question is, how much you have to invest every month from 25 to 60 during your working life? Investment per month. How much? That's the question. For all these things, the applicable rate of interest being 0.12, 12%. Clear? So after 60 up to 400 years, every month, it's not every year, every month you want to earn 10 lakhs. For that, you have to get ready during your working span. During the working year, every year, how much you have to invest? Sir, I don't want 10 lakhs, sir, just 1 lakh, sir. No. How much I have to invest from my 25 to 60 years so that I am able to get the pension of rupees 10 lakhs per month after my retirement? Do you enjoy your parents' money or not? Are you enjoying your parents' money? Won't you allow your next generation enjoy your money? Huh? In that case, assume the next question. This is question number 1. Question number 2. 25 to 60 you work. Okay. 60 to 100 you eat. 10 lakhs pension per month. After the 100th year, 25, 60, 100, you want to create 10 lakhs pension per month for your next generation. For how many generation? How many generation? 7 generation. The 7th generation will prize with big sculptures of you. This is my great granddad gave me so good money. Still, I am enjoying with this money. Yeah. Now, tell me, what is the investment per month you have to make? Investment per month you have to make during your working life so that you can enjoy a decent pension life. Thereafter, you allow your 7th generation to enjoy 10 lakhs per month. This is a nice question you have to answer. Right. Now, let me finish up this illustration. One more part. As I already told you, for the present value of annuity, this formula not required to memorize. See, in your non-scientific calculator, you do the present value calculation. Okay. See, use the calculator. Come on. 1 divided by rate of interest being 10, no, 1 divided by 1.1. It's like a present value factor. This is the present value factor. Present value factor for the first year, second year, third year, 3 years only, no. Then in your non-scientific calculator, you may have the GT button. You press the GT button, you will get the answer directly. Yeah, you no need to mug up. If it is being the present value annuity factor, it's very simple. Find out the PV factor for the year 1, year 2 up to N and then take the grand total. Sir, I don't have the grand total button, sir. No problem. 1 divided by 1.1 equal and memory plus, second equal, memory plus, third equal, memory plus, then memory receive. You get the value. It's very simple. Forget about this formula. This is nothing but summation of PV factor for all the years. So you can calculate the PV factor using your non-scientific calculator easily and just press the grand total. The summation will get that will be the answer. You don't need to mug up. You don't need to go for the tough calculation and all. Is that clear? So pension calculation. Now, this question, I may answer it later if you want. Or you can try it yourself. I will discuss that in the next class. Okay. SSA takes out A loan of rupees 5,000 with a compound interest rate of 10%. The loan needs to be repaid in equal installments. That installment includes interest also, equated annual installment. Otherwise, it may be named as equated annual installment. You might have heard about the term EMI, right? Very often. EMI is nothing but equated monthly installment. To make this sum simpler, I may use annual installment. That's all. Monthly installment means in a 5 years period, you have 5 into 12, almost 60 installments. So it may be very comprehensive. So I convert that into the equated annual installment at the end of each year for 4 years. See here 0, 1, 2, 3, 4. I borrowed 5,000 rupees today, where the borrowing amounts to 10% interest. So that entire borrowing along with interest I have to repay in the future. That future payment will be equal value P. So you know that this value is calculated. Okay, this value is calculated. Probably some value is calculated this way: P into 1 plus I to the power n minus 1 divided by 1 plus I to the power n into I. But we have to calculate a reverse case. Then 1 plus I to the power n into I, this is into I, okay, divided by 1 plus I to the power n minus 1. The formula will be inverse here. Formula will be inverse here. This value very easily you can calculate, which is nothing but 1 divided by 1.1. Take the present value factor for the first year, second year, third year, and fourth year, and press the grand total button. Is that okay? See here 1 divided by 1.1 first year, second year, okay. So 1 divided by 1.1 first year, second year, third year, fourth year. Take the memory receive 3.169865. Otherwise 3.1699. Am I right? 99. But it is inverse. It is inverse. So inverse being 1 divided by 3.1699. What is the value here? 0.31555. Okay. 0.3155. Now P is equal to some value being 5,000 into this value. This is called capital recovery factor. You no need to name. This is inverse of the present value anti-factor. 0.3155. What is the ultimate value you are having? 1577. So your every year payment may be 1,577. If you are paying 1,577 year after year, first year end, second year end, third year end, fourth year end, you will finish off your entire debt. 1,577 into 4, what's the value you are getting? Probably 6,000 something. For the 5,000, you are paying more than 5,000, 6,000 plus. That excess payment may be interest. You can cross verify. So answer is over. Answer is over, but you can cross verify. How? 0th period, your borrowings being 0th period, your borrowings being 5,000 rupees. Up to the first year, the borrowing remains outstanding, and interest will be applicable by the end of first year. Interest for the first year at the rate of 10%, 500. If you go to the banker, inquire about your outstanding amount, they will say 1,500. Now you pay the first equated annual installment. First installment you are going to pay. The first installment being 1577. After payment, the balance being how much? Come on. 3,023. Am I right? And before you pay the second one, Second year interest will be added. So interest for the second year in this case being 302. This one is how much? 3,923. Now you make a payment of 1,577. After that, what is the balance you have? Okay, interest is added. So 392 is the interest. If I add, then the balance becomes 4,315. Now I'll settle the second due, equated annual installment number 2. How much I will pay? 1577, second installment. That the payment for debt will be constant. 1,577 will be invested or repaid every year. And what is the final value? 2738. Then third year interest will be added on this. So interest for the third year in this case being 274. Now the balance being 3012. Now I'll finish up the third EAI, equity installment 3, 1577. 1435. And then you add the fourth year interest for the fourth year 143. 14 or 144 or 3 1579. Now the last installment, equated annual installment number 4, 1,577 or 79, make it 0. We have finished completely. That's how all the bankers will calculate equated monthly installment. So I used to equated annual installment instead of equated monthly annual installment. You can use the equated monthly installment. Number of rest periods will be higher. 5 years means we may have 60 months. So then you have to calculate interest for every month and n being 60. That's how you can calculate for the practical life in the banking scenario. So what happened here? Calculation of S, for that this is the answer. Calculation of P, inverse of this, which is usually named as capital recovery factor. This is also annuity, but this annuity is called present value annuity. Earlier we saw future value annuity. Here we are discussing present value of annuity. So this is present value of annuity. Okay, this one and this one. Is that clear? Both are inverse. But this formula seems to be pretty massive, but very easily you can remember. How? Very easily you can remember how. This is nothing but summation of PV factor. Summation of PV factor. For PV factor, you can use the non-scientific calculator easily and just put the GT button last, so you'll get the answer comfortably. Okay, you no need to apply this formula at all. Now what happens? The next case, a variation. 23rd we'll see now. Come on. 23rd one. So Udayashri has given me the answer. Amount to be invested per year being how much? 82 lakhs per month you have to invest. That's how Udayashri has given me the answer. Let's see. We'll verify later on. Okay. Now let's see this question. SSA borrows 6,000 and repays the loan in 4 equal annual installments of rupees 1,000 each. 1,200 each. What happens here? 0, 1, 2, 3, 4. 6,000 is the borrowing. For that, the repayment being 1,200 for every year. 4 equal installments. It's not possible. It's not 1,200. You make it 2,400. You make it 2,400. The value should be higher than 6,000, right? 1,200 for 4 years is 4,800, which is not practically possible. So 2,400, 4,800, 4,800, 4,800, and 4,800. Now in this question, you have to calculate rate of interest. Rate of interest. How can you calculate the rate of interest, sir? You can use the trial and error method. You know 6,000 should be equivalent to 4,800 multiplied with the PV, present value of annuity factor, PVAF. Don't rewrite that formula. You can use this term present value anti-factor. It's very simple. Otherwise, my required present value anti-factor should be 6,000 divided by 4,800. What is the value you are getting? 1.25. So this is 2,400. No. Okay. The periodical investment being 2,400. I missed totally. Okay. Yeah. 2,400, 2,400, 2,400 and 2,400. Correct the question. Okay. Now 1,000 divided by 2,400. What is the final value? 2 point. You have to get the present value factor 2.5. Now you have to find out what rate of interest will give us the P factor 2.5 by the end of fourth year. By the end of fourth year, I need to calculate I, the year being 4. Present value factor for the ith rate for the fourth year should be 2.5. Now I can calculate the I by using trial and error method. Trial and error method. Now, if the I being 16%, we can assume it is being 16%. What happens then? Find out, come on. P factor, how much is this? 16% P factor. So 1 divided by 1.16. This is P factor for the first year. Memory plus second year, third year, fourth year. Add up of all these things. The total value being 2.7982. 2.7982. And 2.5 is the required one, not matching. So the value is higher. Now you have to reduce the value to 2.5. To reduce this, you have to increase the interest because it's a present value. In case of future value, to increase that value, you have to increase to reduce the interest rate is reduced. In this case, inverse will happen. To reduce, I have to increase the rate. To increase, I have to reduce the rate. So I have to increase the rate. So rather than 16, I may assume it may be 18%. Come on, get me the value for 18%. What is the P factor? P present value anti-factor for 18%? 2.690. That's all. Okay, 2.5. Also not matching. Still, I have to reduce further, so I can go for 20% also. If it is being 20%, what's the value? 2.588. Also not matching. Then I can be raised to 22%. If I can be 22%, maybe 22%, what is the value? 2.4936. Almost this is the right answer, right? Closer. One higher number, one lower number, then required answer should be anywhere between 20 and 22. Now you can use the interpolation. See here. Rate of interest. If the rate of interest being 20%, my value being present value anti-factor being 2.588. Okay. If the rate being 22, the present value anti-factor being 2.4936. By making 2% change, what is the change in present value anti-factor? 0.0944. But my change is I have to make this being 2.5. Now 0.088 to be changed. 0.088 to be changed. Now you can use this being the cross multiplication. Between these two, lower number will be taken. So from the lower number, now include this value 0.088 divided by 0.0944 into 2. What is the final value? 21.86% is the correct value. 21.86. Now you can try whether you are getting this value or not. See, 1 divided by 1.2186 P factor for the first year, memory plus, second year, memory plus, third year, memory plus, fourth year, memory plus. The grand total of this memory is 2.5. Okay, we get this answer. Clear? That's how you can calculate all this rate. For CA Inter as well as CMA Inter, you might have studied this in your IRR. This is the calculation for IRR. For all the chapters what you study in financial management, this is the father of all. Unless you know that, others may be always confusing. Clear? In IRR, what we do? In case of IRR, 6,000 rupees invested at the 0th period, that fetches me 2,400 cash inflow for 4 years. What is the rate of means IRR? For that we are using this one. There we study a new chapter, but it is nothing but the same chapter. Clear? The same ones studied as a time value of money. If it is clear, text me. We will move on to the next illustration. Only 3 more illustrations. With that, all the concepts over. Srimati has asked me the doubt how to calculate after 100 years, sir. I will come. No issues. Wait. Here, all the students are working for that now. Mentally, they are preparing. Isn't it? Preparing or not? Okay, then. Good. Shall I move on to the next one? Three more illustrations to go. Now, present value of annuity where the payment made in advance. Usually annuity will be made only year end, but here it is made in advance. SSA receives early pension of 1,000 at the beginning of each year for 3 years. Okay. 0, 1, 2, 3. He gets pension of ₹1,000 every year beginning rather than every year end. Right. With the compound interest rate being 10%. What was the total amount of money SSA had at the beginning? What could be the sum value they have at the beginning? Right. How can you calculate, sir? How can you calculate, sir? You are aware about that, right? In case if the annuity being periodically once the year ends, right? That will be very simple. But rather than it's year end, it's year beginning. Now I can subdivide this formula, this equation into 2 parts. Can we make this way? This one separately, this part. Another one is at 0th period, you have 1,000 rupees. This is separate, this is separate. This seems to be regular one, right? First year end, second year end. You have to take the annuity factor for the 2 years. Present value annuity factor. If it is being the advanced one, you have to calculate the P factor, present value annuity factor for 1 year lesser. 1 year lesser. See here. S is equal to P into present value annuity factor for 10% for n minus 1 year. Not n year, n minus 1 year. Okay, because you skip this, automatically what happens? The stream looks like the present value annuity factor, but 1 year short. Clear? Okay. Now, what about this 1,000, sir? 1,000 is nothing but adding one more 1 P. P into 1 P. The P value will come automatically. So, whenever the present value annuity factor starts with year beginning, usual PV factor you can take but 1 year short, at the last add 1 extra. That's all. For this you are adding 1 extra. For this you are adding 1 extra. So now 1000 into what is the PV present value of annuity factor for 10% for 2 years rather than 3 years we have to take for 2 years. Come on, tell me. Okay. For 2 years 1 divided by 1.1 first year memory plus second year memory plus and memory reserve, it is 1.7355. 1.7355. Don't forget to add the 1. 1 represents one more 1000. One more 1000. 1000 into 1000, right? This is for 2 years, this is for another year. Then overall value being 2735. 2735.5. Is that clear? See here the formula. Present value annuity if the payment in advance. Usual formula being S is equal to P into 1 plus I to the power n minus 1 divided by 1 plus I to the power n into I. But in case of advance, this n is not absolutely n, it is n minus 1, 1 year short. Okay, but don't forget to add finally one more 1 here. The formula seems to be pretty massive, but I made in such a way to remember easily. So 1 plus I to the power n minus 1 divided by 1 plus I to the power n minus 1 and rest will be the same like. Instead of that, you add 1 extra. Okay. So present value annuity factor where the payment is in advance, the same formula, but annuity factor will be calculated 1 year short. Don't forget to add 1 extra. That's all. 1 extra. Clear? Text me once it is over. I get the message only from one of you in online. Come on, what about the rest? Make it faster. Yeah. 25. Where present value annuity cash flow being uneven. In case of uneven, you cannot use the formula, you have to calculate independently. What is the present value of the following cash stream if the discount rate is 14%? So year 0, 1, 2, 3, 4. The cash inflow you are getting 5,000, 6,000, 8,000, 9,000, 8,000. If the cash flow stream being equal, no issues. We can apply the formula. If it is being uneven, you have to calculate each and every item separately. For this, it's already at 0th period, no problem, no adjustment. For this, you have to bring 1 year earlier. 1 year PE factor, 2 year PE factor, 3 year PE factor, and 4 year PE factor. So, calculate PV factor at the required rate of interest being 14%. So, 14% PE factor. Very first year, 0th period remains the same. So, name it being 1. Apart from that, come on. 1 divided by 1.14. This being 0.877. Then again equal second year, third year, fourth year. If you take the summation, you can apply this provided this cash inflow should be equal. But here it's not equal, so you cannot sum the present value factors. You have to use the present value factor independently for each and every item. Here the value being 0.769, 0.675, is 0.592. If you multiply these two, the value what you get is called present value of cash inflow, or otherwise named as discounted cash inflow. Present value cash inflow or discounted cash inflow. 5,000 into 1, 5,000. 6,000 into this one, 5,262. 8,000 into this one, 6,152. 9,000 into this one, 6,075. 8,000 into this one, 4,736. Then summation of all this value being 27,225. The present value of these cash flow stream being 27,225. If the cash flow being even, then you can use the annuity factor. If it is uneven, you have to use P factor independently for each and every item. That's all. Suppose this is called summation of discounted cash inflow. Suppose if they have given, sir, for this cash inflow stream, we have to invest cash outflow at 0th period being 25,000. If they ask you, is it worth it, sir? I have invested 25,000 at the 0th period. Because of this investment, I am getting so much year after year. What is the total value in absolute sense? Come on, tell me. What is the total value? 36,000. So I invest 25, I am getting 36, I am getting 11,000 rupees. But of course, we cannot compare directly because today's value is higher than the tomorrow's value. Tomorrow only I am getting 36,000. Today's value of that 36,000 may be lesser. The today's value of this 36,000 is arrived by this way, which is 27,225. For that, how much you have invested at 0th period? 25,000. You invested 25,000 rupees today. Because of this investment, you are getting 5, 6, 8, 9, 8,000 rupees in the coming years. Now my question is, what is today's value? Today's value of all this cash inflow being 27,225. For that, I invested 25,000. So naturally, I am getting 2,225 excess. This excess is usually called as net present value. Okay, this is present value. From there, if I subtract the cash outflow, I will get the net of that. That's why it is called net present value, NPV. At your inter level, you will study all these things in your capital budgeting concept. Okay, net present value and internal rate of return. Foundation level, it's only application, means understanding the base. At inter level, you will apply in detail. Clear? Okay, so one more illustration. With that, all the concepts are over. If you want, I will finish up that illustrations also. Okay, that's your choice. Do you want to get 10 lakhs rupees pension per month or not? We'll see. If it is clear, text me. So we'll go for the last illustration, 26. Come on, try the 26th illustration yourself. I may explain this. Without seeing the answer, try it yourself. 26. Get me the answer. Online students, come on. Is it clear? Can I go for the next illustration? Question number 26. Right. Find out the present value of annuity but belated. A 12 payment of annuity 10,000 will begin 8 years hence. The first payment occurs at the end of 8 years. What is the present value of the annuity? The discount rate is 14%. Okay. So what happens here? 12 payments. Will begin 8 years hence. Okay, 12 payments. Zero, 1, 2, 3, 4, 5, 6, 7, 8. First payment of rupees 10,000 made on first payment made on this date. How many 10,000 payment is made in the future? 12 such payment. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 12 such payments were made. So every year end you are making a payment of 10,000. Is that okay? 10,000, 10,000, 10,000, 10,000. Count how many 10,000s are there. You get 12 10,000s. What about the years 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19? Some students will always get confusion. Sir, already 8 years, 12 years means 20 years, sir. No, it ends on 19th year. How can you calculate? Stream of payment. Then you can use the annuity factor. Stream of payment, you can use the annuity factor. But in this period, the stream is missing. In this period, the stream is missing. What can we do, sir? Very simple. Find out the present value annuity factor at the rate of 14% for 19 years. From there, find out the present value annuity factor at the rate of 14% for this period. For this period. Okay. How much is this? 8 years. Okay, 8 years. Now from this, if you subtract, then you will be getting what? Present value annuity factor for 14%, starting from 8 to 19 year. Okay, or 9th to 19th year. 9 to 19th year. You'll get the values. Is that okay? Yes, come on. What's the P factor for 14% for 19 year? Make it faster. This is one approach. The other approach given in the text, you can try it. Okay, come on, tell me. Come on. Hmm? Which one? 6.550. Find out for first 8 years. Hmm? 4.639. Now the difference between these two, 1 point. There's slight error. Let me check. Let me check. I think the first answer itself seems to be error. Yeah, okay, 6.550. Now you take it for 7 years, then 7 years, 1 year short. Okay. From 8th year onwards up to 19th year, balance you can get this value. Come on, for 7 years, what is the value? 4.288, and you will be getting the present value anti-factor for 8 to 19 years. What is the value? 2.262. Now you multiply with this value. The amount required being 10,000, then anti value being 22,620. This is how you can get the answer. There is one more method. One more method. You can calculate in Singar Academy text. I have given this way. You calculate this one first of all. 1 to 12 years, 12 years payment. 0, 1, 2, 12. Every year end you are getting invested 10 rupees. What about its present value, where the I being 14%. Now you can calculate this first of all. For 12 years you have to calculate. 10,000 is multiplied with PV factor for present value anti-factor for 12 years at the rate of 14%. Come on, get me the value. 5.6605. Am I right? If you do this, you will get the value here. You will get the value here. If you multiply these two, no, the value what you get is nothing but this value, 56,605. Isn't it? A stream of income, if you are discounting, you will be getting year beginning value. From 0 to 12 years, the value, if you find out the today's worth, it will be 0th period value. As per the continuous stream, it is for this year. Again, you have to bring it to this place by applying the PV factor, single amount PV factor. Single amount PV factor being 56,605 multiplied with the PV factor at the rate of 14% for how many years? 7 years only. 7 years, 14%. So 56,605 into 1 divided by 1.14. 7th year PV factor. Year 1, 2, 3, 4, 5, 6, 7. What is the P factor here? How will it? It's a PV factor is different from the anti factor. It's a P factor. Be careful. Here anti factor, here P factor. Get me the P factor. My calculator is very slow. Okay. 1 divided by 1.14. 1, 2, 3, 4, 5, 6, 7. 3? 3996. Is it so? Yeah, 0.3996 or 0.4. 0.4. What's the final value? 20? Similar answer you will be getting. Similar answer you will be getting. Is that clear? Okay. Oh, my calculator is not working properly. So I have to change. You have to change. That calculator is very nice. While calculating this way, if you don't use proper calculator, you will get tensed. So many calculation, no. That's why I told you in the very beginning itself, use the calculator and master yourself using the calculator. Else you'll get lots of confusions. Hope now you'll be able to understand all these concepts much better way. With that, all the logics of time value of money is over. Okay. Either this way also you can calculate. These are the advanced type question. These are the advanced type questions. Either you can use this way or this way. You can think and you can apply the time value of money as you wish. As you wish. Do lots of practice. Do lots of. Tomorrow you will have the practice session on this topic. Until you master of this time value of money, we will have the practice session on this one. Clear? Okay. Now let's get back to this general question. Sir, already I thought we can leave the home, sir. Leave for the home, sir. Would you like to try it yourself? Not now, tomorrow. And now itself. Or do I want to try it myself? Do I want to explain this? Can we go for again voting? How many of you want this answer today? 1, 2, 3. Others, God, leave me please. Then those who wants the answer can stay here for 5 minutes. Okay, we'll finish up late. Right, let's see how to solve this illustration. Now what happens? 0, 1, 2 goes on. 25 years. Every year has how many years? 35 years. Thereafter, you need to get pension 40 years. Let me try to finish up the first question first of all. Okay, 35 years and 12 months. 35 into 12. 420 months you are going to invest. Thereafter, 40 years you need to get the pension. 40 years into 12. 480. 480. Is that okay? So naturally it may be 900th month. 900th month. Every month you are getting 10 lakhs every month. Up to this period. This is during your retirement. During your retirement. Pension being 10 lakhs per month. For how many months? 480 months. Now the question is how much you have to invest during your working career per month. For how many years? How many months? 420 months. So you are working for only 35 years but getting pension for 40 years. 10 lakhs you want. Then how much you have to invest? Let's see. Now if I take the present value, in this case you have to find out the present value anti-factor, this block. You have to use present value anti-factor first of all, so that you will get how much you are in need at this time, present value factor. So 10 lakhs into present value anti-factor, the rate of interest in this case being 12%, right? Otherwise 1% per month. 1% per month. Okay, 1% for how many months? 480 months. 480 months. So 10 lakhs into 1 plus I, 1.01 to the power 480 minus 1 divided by 1.01 to the power 480 into 0.01. You can depend on scientific calculator. Okay. 1.01 to the power 480 minus 1 This is the numerator value 117.65. 117.65. Denominator value, add 1 and multiplied with 0.01. Denominator value being 1.186465. 1.1865. Then what about the final answer? 10 lakhs into 117.65 divided by 1.1865. So you need to have 991 lakhs at the time of retirement. 991 lakhs, 9 crores, 91 lakhs, roughly 10 crores like. So you need to have 991 lakhs at the time of retirement. Part 2. To have 991 lakhs at the time of retirement, how much you have to invest every period? Second block. This block we have to use what? Future value anti-factor. If I invest some money periodically, how much I will get in the nth period? Then it's called future value anti-factor. So I am going to use the future value anti-factor. Second block. Is that okay? For this, future value anti-factor is equal to P amount invested every period multiplied with 1 plus I to the power n minus 1 divided by I is the answer. But I know this value. Let me finish up the second part. F being 991 lakhs is equal to, I need to find out the P and 1.01 to the power n, in this case being 420, minus 1 divided by rate of interest being 0.01. Now I have to get the answer for this. 1.01 to the power 420, okay, minus 1 divided by 0.01, this value being 6,431. 6,431. To get the P is equal to 991 lakhs. 9 crore 91 lakhs. Am I right? Divided by this value 6,431. Now 9 crore 91 lakhs divided by 6,431. You have to invest only 15,410. So simple investment. Even it's an amazing thing. Okay, these things I calculated in my day, so I started investing small money. You don't need to expect big amount. Those are the cheating. Even matter of 12%, banker will give 7 or 6%. But if you are investing in the stock market, you can decent make around 12 to 20% also decent. That is enough. Overnight billionaire is always cheating. Scam. This money, see how quickly you become billionaire. At the time of retirement, every month 10 lakhs. 15,000 rupees you are investing today. 35 years only you are working. Thereafter you are getting almost 10 lakhs for remaining life. Big money, right? Each and every penny should be now invested in such a manner. So I always get passionate while playing with the rate of interest. Because of this one only, when I want to purchase, probably I may go for purchasing some. That's the idea I got from Warren Buffett. So their culture, they have the pizza and one Coke. Rather than purchasing the Coke, he purchases the pizza. For the Coke, he purchased Coke company's share. One Coke may be $10. He uses the $10 for purchasing the pizza company's, means the Coke company's share. Now he has almost more than 2 lakhs to 3 lakhs crore rupees as his asset. 3 lakhs crore rupees. So big number. That surprise you'll get because of this interest calculation. All the financial planners and advisors cheating others only by stating this one. Small money with a decent committed investment, you become billionaire just like that. Just like that. So nice, no? Do you want to get the answer for the second one? You want to leave property for seven generation. Seven generation. Okay. Not sir, not seven sir. 7 to 7 sir. In this case. Now see, if you want to get 10 lakhs, if you want to get 10 lakhs year on year at the rate of 1%, how much you need to have? Very simple, divided by rate of interest. Come on, tell me. 10 lakhs divided by 0.01. 10 lakhs divided by 0.01. 10 crores. You need 10 crores only, or 1000 lakhs. You need only 1000 lakhs. Rather than 991, if you have 1000 lakhs, matter of 9 lakhs extra, you are now leaving a legacy for your next generation. You now, instead of this, you take the 1000 divided by 1000 means 10 crores. Okay. Divided by 6431. What is the answer you are getting? Matter of additional investment of 140 is more than enough to leave a big legacy after your generation. In LIC, you know, lots of plans are there. You just inquire your parents. 3-generation policy. 3-generation policy means some maturity period you will get money. At the time of death, there will be a compensation payable to the the nominee. Even sometimes later, 18 years or 20 years later, your next generation will get. That's what about 3-generation policy. If I want to get the 3 years, they will ask the premium maybe around 1500 rupees. They will ask, do you want to leave some extra benefit for your third generation? Yes, sir. Means around 30 or 40 years later. Yes, sir. You have to add another 100 rupees extra. This is called rider plans, like in LIC. So, if I ask you, do you want to get 10 lakhs during your retirement life? Yes, sir. Do you want to leave 10 lakhs for your next generation, for 7 generation? Yes, sir. Pay just 140 rupees excess. So nice, no? So all these things I can gain. Now it seems to be achievable. Becoming crorepati is achievable. Small money with this decent 12% return, you become billionaire. Go and sleep with billionaire dream in your mind. That's all for today.